Hey everybody, welcome to the What is Money Show. I am thrilled to have you here joining me on my mission to help shine light on the corruption of money. Now, if this is your first time listening to the What is Money Show, I strongly recommend that you go back to episodes 1 through 9 first, which lays a lot of the groundwork for many of the concepts that we explore on the show. These first 9 episodes are my series with Michael Saylor, and thousands of people have told me that this is the best podcast series they've ever heard, hands down, and that it was instrumental to their understanding of money and Bitcoin. So if you're looking to start a deep dive into the nature of money, I don't think there's any place better that you can start other than episode 1 of this show. Now, a little bit about this show and how it makes money. The What is Money Show is 100% sponsor based. So all of our revenues are derived from direct sponsorships. And I strive to be very selective about the sponsors that I work with, specifically only using sponsors that I use personally, and also choosing sponsors that have values which are well aligned to the values expressed on this show, such as freedom, education, self-sovereignty, etc. So what I'm going to do now is a few ad reads right at the top of the show, and then I'll do a few more ad reads in the middle. And I hope you'll take the time to listen to them, as again, these are hand-selected sponsors, and I think you'll like what they have to offer. Today's podcast is brought to you by In Wolf's Clothing. Wolf is the first startup accelerator dedicated exclusively to the Bitcoin Lightning Network. 4 times per year, Wolf brings teams from around the world to New York City to work with like-minded entrepreneurs, pushing the boundaries of what's possible with Bitcoin and Lightning. The program is designed to help early-stage companies achieve product-market fit, develop their brand, secure early-stage funding, and grow businesses that help fuel the global adoption of Bitcoin. So go to wolfnyc.com to learn more about the program or apply. Again, that's wolfnyc, WOLFNYC.com. George Gammon.
Yeah.
Welcome to the What is Money Show.
Thanks for having me. It's really nice of you to invite me over. I just happened to be in Miami. I didn't even know you were here. I think the last time we met face to face was at maybe Mark's deal.
Yeah,
I think in Dallas.
In Dallas, that's right.
Yeah. So it's just great to see you.
Yeah.
It's great to see
Likewise,
you
man.
be out here at your place. It's just an amazing venue that you have here, and I don't want to give away where it is. We'll leave it at that.
Somewhere in a red state in the U.S.
Yeah.
And the last time we saw each other, probably about a year, maybe more, in Dallas.
A little more now.
Yeah. And this just worked out, man. You are the third person here to be in the new studio. I actually do disclose this is in Miami, so it's okay to say that.
Okay.
And we were tweeting at each other, as we tend to do sometimes.
Yeah.
And then I was like, you know what? Twitter's not going to work for this. Let's just talk. And then sent you a DM, and you just happened to be in Miami.
Yeah.
So it just worked out.
Yeah. And it's total spur of the moment coming here as well.
Yeah.
You know what I was thinking about? I've had some of these interactions back and forth on Twitter, and you just cannot capture everything that you need. The way that we communicate as human beings,
Yes.
there's so much that's lost in just pure text.
That's right.
I was actually wondering if in the future, Twitter would have a feature where you could actually, instead of a 140 character texting, you could have like a 15-second audio, and that would be the tweet of the future. I think it would be a lot better as far as the ability to communicate with one another if you could not only read it, but you could hear the way the person was saying it as well.
Yeah, I've noticed a lot when I'm traveling internationally. Often in Latin countries, they use voice notes much more.
WhatsApp, they do that
than text.
Yeah,
and I assume they're doing. No, actually, I know it's voice notes because I see them listening and sending them back.
Yeah,
and there's definitely, you give up some nuance when you go to just text. Obviously, there's advantage to text too. If you're thoughtful with it, which a lot of people aren't on Twitter, it's just kind of spraying the text. But if you really take time and reflect on it, there's an advantage to that. But I agree, especially when we're talking about these. We're having these arguments online about money, about finance, about economics. These domains are just confusing, frankly.
Yeah.
And one of the things, we just had lunch here. So we talked offline for a couple of hours before we started. It occurs to me that a lot of this is probably terminological. So like when you say the word bank reserves, for instance, is not the same term bank reserves I'm reading in Mises from 1940, right?
Yeah.
And so there's
and velocity.
Velocity. So you end up talking past each other.
Yeah.
And so you have to, this is why so often on the show we come back to definitions of terms, then converse. So
what's funny about our exchange is I actually DM'd Bob Murphy.
Nice.
And I DM'd him and I kind of tried to summarize what we were going back and forth about with velocity. I'm like, Bob, what am I missing here?
Yeah.
I'm like, because I know Robert.
Yeah.
And not only is he a super smart dude, but he is very objective, which is rare in the macro space or the Bitcoin space, the gold space or whatever.
I'll take that as a compliment, but I'm just trying to learn too, frankly.
Yeah.
And,
but many people, and this is a compliment that I've given to Bob Murphy, so many times, is that you can tell Bob is someone who's a real thinker.
Yes.
And he has an open mind.
Yeah.
And this is someone that I assume Bob has his PhD in
I think so,
economics. Yeah. But he is, the top shelf when it comes to Austrian economics. But I know Bob well enough to know that even if something, he was given data or information that was contrary to his view, he would do his very best to try to understand it.
Of course.
And if based on the data, he thought that his previous view was incorrect, he would have no problem shifting that view.
Of course.
To where he's always evolving.
Yes.
Right. And I think that is just so rare, just in any space.
Yes.
We as human beings, we're trained a certain way, or we have certain views, and then we just like to dig our heels in and just keep those views for the rest of our life and never change, because it impacts our entire worldview.
Yes.
And I think as men as well, we have to have a sense of purpose and a sense of identity. I think we all do as human beings, but especially men.
Yeah.
That is just like priority number one. And so if your whole identity or your purpose is wrapped up in a certain philosophy, it makes it very hard for you
identity
to
crisis.
Process. That's right.
Yeah.
New information and actually change your current views. So I think that the people who would fall into that category are far and few between, but I think that you and Bob are right at the top.
I really appreciate that. And you could almost say the masculine energy is the assertive, right? And feminine energy is receptive.
Yeah.
And so if we're going to be asserting things, right, like making claims or arguments, well, you have to sort of be attached to your ideas in a way, right? You're trying to make a point, literally. But you also have to be humble enough to know that, knowledge is finite and you can often be wrong. Otherwise, you're never going to learn. So there's kind of a trick to it, right? It's like it's part of your identity, but it can't be fundamental to your identity.
Yeah.
Otherwise, you're never going to learn.
Yeah.
And I think the humility that is intrinsic to that is increasingly important in this digital age where things are moving faster and faster and faster. If you're not open to learning new things, you're going to get further and further left behind as the world is changing even faster.
I had dinner with Snyder the other night, and one of the things that we discussed was trying to figure out what our worldview would have been around macro and the banking system and money, all the things that we talk about, if we were studying this in the 1950s and we only had access to the information, the charts, the data that like Milton Friedman had in the 1960s, would we have come to different conclusions? And the answer is probably not. Because like velocity is something that we were going back with. Friedman thought that was a constant.
Yeah.
And you can see why. Because if you look at the although it's almost impossible to measure, if you look at the way they measured it back then, it was very constant. If you look at it through the 1900s.
Was this MVPQ? Was that the equation he was looking at?
I have no idea. The equation, I assume they measured it back then like they do now. It's just basically money supply and GDP.
Yeah.
So he thought that velocity was constant, but based on the information that he had, that was the obvious conclusion. But then we get into the 1980s and the 1990s, and we see that no, it might not be constant and it might fluctuate. But then it becomes even more challenging because we get to a point now where we're like, should we even be measuring money through M2 or through M1 when there's so many things in the financial system today that would have, I use this term with Lynn and Jeff the other day, with moneyness to them. That's not my term. That's Manmohan Singh, which is a guy that I have to introduce, not like literally, but show you his stuff because you would love the work that he's done with the IMF. But he gets into the moneyness.
Yes, it's an attribute, not a thing, right?
It's the way it's used.
Yeah.
So the features of certain things. So what he does often is he would compare a treasury to a bank reserve and say that both, at face value, you would say, okay, well, the bank reserves are the green piece of paper. They're more like money, more transactional than like a treasury. But if you look at that in terms of the banking system and the way that treasury is used, there's a strong argument that treasury is actually more like money or has more moneyness than the green piece of paper or the bank reserve. And the reason he gives for this, just in simple terms, is because the pipes that connect the plumbing with the financial system, there's more pipes that treasury can go through than a bank reserve because there's only so many entities that have a pipe that leads to the Fed's balance sheet.
Right. Gotcha.
Before you have to get through corresponding bank relationships and all these things. So therefore, that treasury is more universally accepted.
Bigger network.
That's right.
Yeah.
Bigger network. You got it. So in those terms, if we're looking at it through that lens, you could argue and you could see why that collateral would be more useful to those entities than the bank reserves themselves.
Gotcha. So, all right, I want to get into velocity, but I want to first start with the what is money question because you did a great episode with Lynn and Jeff. I don't know if it was a couple months ago, maybe.
Yeah, it's like a month ago. On Jeff's channel.
And you guys did an episode on what is money, and it was a really good discussion. There's a lot of different ways to approach the idea. Lynn's like, okay, what is it mechanically? What is it philosophically? There's different aspects of money, let's say. But I don't let me forget, I want to know what Bob Murphy said about velocity because I think we'll come back to velocity, but don't let me forget. I want to revisit that.
Yeah, so I've been on vacation. I haven't even checked my Twitter to see.
Oh, you haven't seen it? Okay. All right. Maybe we'll check it later.
I think I could probably pontificate a little bit. But what was interesting about Lynn and Jeff, that conversation, goes back to your earlier point about definitions, is, I know them both personally really well. And so I understand their position, such as does the Fed print money? That's a big question.
Yeah, that was a good one.
Yeah, so I know.
Can we go into their views on that a little bit, if you don't mind?
But their views are the same.
Yeah,
it's just they describe it two different ways, and that's why definitions are so important. Yeah. And what's funny is prior to that, everyone thought that Jeff and Lynn have completely opposing views. And I thought Jeff and Lynn maybe even have thought that about one another. But I got in the middle of them. I said, no, guys, you don't understand. You're just using different words.
That's right. So
when I just phrased it a different way, they're like, yeah, we totally agree on that. So when I phrased it, not does the Fed print money, but does the Fed doing QE or QT, can that impact M2 money supply? I said, Jeff, what do you think? Yes.
Bingo.
Lynn, what do you think? Yes. But Jeff, does the Fed print money? No. So it's
you had to get more precise with them too.
That's right.
To get them into agreement.
That's right. You have to get precise, and you have to have your definitions straight.
Yes.
If you don't, you're just going to get these people that are just incredibly smart that actually do agree, but yet they just talk past one another. And as an innocent bystander, you think that they completely disagree on everything, when in reality, there's like a 95% overlap.
Yeah, no, that's excellent work. Ayn Rand said, definitions are the guardians of rationality and protection against mental disintegration. So you literally have to be on the same page. We have to have social consensus on terms before we can even have a conversation.
Yeah.
And so you can get people saying, we don't print money. But if you get them down to M2, something more specific, then you bring them into consensus.
That's right.
You get them consensus on terms, then you get them consensus on concept. So that's
right, because
that's
what we're really talking about isn't really opinions. Most people think that like Jeff has an opinion on money printing, or Lynn has an opinion. No, all we're doing is just talking about how things actually work.
Yeah.
And when you get down to that, there's no disagreement because we're just talking about balance sheet transactions.
Exactly.
And that's not really an opinionated thing.
Yes.
It just is what it is.
Yeah. Once you got to the accounting terminology, you resolve the conflict.
Yeah.
Which is great.
And same thing with, does the Fed's balance sheet matter?
Yeah.
That's something that I say, not really. But then if you pin me down and say, can they bail out a bank?
Yeah.
Is that absolutely? Of course they can. Of course.
Right.
But what I'm talking about when I say the Fed's balance sheet doesn't matter, bank reserves don't matter, is the 99% of the time when they're not bailing out a bank. So if the Fed is doing QE, let's say, in 2015, does that matter? No, because the banks really aren't even using those bank reserves. And going back to the moneyness, we could argue that they're actually taking liquidity out of the system because they're taking those treasuries that have more moneyness to them.
Yeah, that one.
They're taking those out. So in times
that threw me for a loop earlier, so maybe you could run through that again. You described to me earlier that it depends on the buyer of the treasury, whether it's actually
the seller.
The seller, sorry.
Assume we're doing QE.
So it's either bank or non-bank.
Correct.
Seller actually determines whether or not it's expanding the money supply.
Correct. If you want, but again, how are we defining money supply?
We'll say M2. Stick with
M2. There you go.
Yeah.
And so I would take that a step further. It's not just M2, but for the viewers, they need to realize that M2 is basically a commercial bank deposit liability. So that's what we're really talking
money
about.
People put in the bank that the bank
there's obviously there's currency in circulation and whatnot, but what we're really talking about are checking and savings accounts. So we could even narrow it down to like M1.
Yeah.
But we're talking about commercial bank deposit liabilities.
Yeah.
So if the Fed does QE, if they're out there buying a treasury, they're going to do that through a primary dealer. So it's just open market operations. The Fed, Jerome Powell doesn't say, hey, we want to buy $1 billion of the treasuries from non-banks. It's indiscriminate. So what they'll do is it depends on who's selling. That's who they're going to buy from. And if the banks are not selling, then the only people that are selling or entities are non-banks, and therefore that transaction is going to impact M2 or the commercial bank deposit liabilities. If they're buying from a bank, it's not. So what happens there is, as far as the plumbing, if you, Robert, you're a non-bank, you're selling a treasury, you don't want to use it anymore, you want to buy a stock or whatever. So you just happen to sell that in the open market, and that ends up on the Fed's balance sheet. Okay, so what do you get in return for that treasury?
Dollars.
That's right. Yeah. But more specifically, you get additional commercial bank deposit liabilities because they increase your checking account.
That's right. An
balance.
IOU from the bank, basically.
That's right. Yeah. So that increases M2, right? Whereas if you are the bank of Robert and you have an account with the Fed, then they're just increasing your reserve account. So there's no impact on M2 at all, because the transaction is occurring exclusively on the Fed's balance sheet.
And what is the relationship? This is the other thing that threw me for a loop earlier. The relationship then between bank reserves and the reserve requirement.
Yeah,
because you said something changed in 2020, I think.
Yeah, they just got rid of it, but it was like a nothing burger. Anyway, the banks were completely ignoring it. And the specific example, if people just want to do the math, in 1980 there were 40 billion with a B of bank reserves, and keep in mind that included vault cash. So then the question becomes, okay, are the banks using that vault cash to settle? Probably not.
Which should technically, if it's not their asset, that should technically be a customer demand deposit liability.
No, it's their asset.
Oh, it is.
So yeah,
bank cash.
It's included in the bank reserve total. So it would go against their 10% reserve requirement.
Okay.
But the reason I kind of compartmentalize is because if it's vault cash, they're probably not using that to settle.
Right.
Which takes us back to a liquidity conversation. We can't say that there were $40 billion worth of base money liquidity back then, because a lot of it was just stored in a vault.
Gotcha.
So it's not circulating. So the banks aren't using it to settle.
Right.
But that takes us down another rabbit hole. The bottom line, bank reserves that would apply to that 10% reserve requirement in 1980, right around 40 billion with a B. Back then, Robert, M2 was 1.5 trillion. So that 40 billion of reserves would have been applicable if there was a reserve requirement, which technically there was, but it would have been applicable to most of that 1.5 trillion, if not all of that 1.5 trillion, right?
So that's 3% or something? What is that?
I don't know right off the top of my head. It's probably not 10%. No, it wouldn't have been 10% because 10%, then you'd only have 400 billion worth of M2. So we had 1.5, so it would have had to have been a lot higher than that. But then you fast forward to 2007, and you've got 7.5 trillion in M2, but bank reserves are 40 billion.
The same.
Exact same. So the math doesn't. There's no way, right? And then you, if to really blow your mind, forget the reserve requirement for a moment. Just think about how many global dollars there were. So we're talking about domestic M2. Think about global dollar M2 in 2007. That what was maybe 40 trillion dollars. And we had 40 billion of bank reserves. So just you can tell right there that there's no way banks back then were even using bank reserves. It might as well have been zero.
And where does that stand today? That relationship between bank reserves and global dollar M2?
Well, bank reserves right now, as we speak, right around 3.5 trillion.
Okay.
And so global M2, I mean, I would guess, there's really no way of telling for sure, but and so M2 is a little tough as well because, again, we're just looking at the liability side of the commercial bank's balance sheets. But if you look at the, a lot of the interbank stuff, the stuff in the shadows that we were talking about before settling, where banks are settling without cash or settling without bank reserves, I mean, I would guess 50, 60, 70 trillion, something like that.
So that ratio sounds like it's declined then because you were saying 40 billion supporting 7.5 trillion.
Yeah, but at the end of the day, the ratio doesn't even matter. It just doesn't matter because if we're not even using those bank reserves,
are they inconsequential completely then?
Well, okay. So here's where we have to go back to be very specific and technical. If the Fed is bailing out a bank, then they're not inconsequential because that's the mechanism by which the Fed is pulling the levers, right? In a crisis situation. But that doesn't mean that they're consequential when we're in 2015 or 2023 and the Fed is just increasing or decreasing the amount of reserves because the banks really don't even need them. Now, I don't know if they're using them or not, but they really don't need to. So then the question becomes, why wouldn't they, right? Because if you think about, let's just say 30 trillion, go back to 2007, say 30 trillion in global dollar M2 here, and they're not even using reserves. Well, why wouldn't they use that to settle? Because at the end of the day, that is final settlement. I mean, not technically, because final settlement should be the gold.
Yes.
Right? But in today's day and age, that is final settlement with a bank when you actually get those bank reserves. But banks weren't even choosing to do that. So obviously, they're taking additional risk. Why would they do that? You have to not only look at the additional risk, but you have to look at the additional reward. And that's the answer, is that I'm not a banker, so I don't know what they were doing. I mean, I think we could probably ask Snyder.
Probably yield, right?
Yeah, exactly. Where by not settling on the Fed's balance sheet, it gave them more efficiencies. It gave, and at the end of the day, more money in their back pocket that justified the additional risk by not settling or having final settlement on the Fed's balance sheet.
Got it.
And so you have to fast forward to today and say, okay, is there greater risk in the system? Well, maybe not. But then you have to look at why would they settle, and has that reward component of the equation gone up or down to the point where they would prefer to settle on the Fed's balance sheet. But at the end of the day, the concept is they don't need to. So if a bank, so therefore those reserves, in my opinion, are never going to restrict the decision-making of the bank. You're never going to go to a bank as a perfect borrower where the bank could make $1 billion on lending you money and them saying, oh, Robert, we'd love to give you this loan and make a ton of money. But we just ran out of bank reserves or something.
Got it.
You know, no bank would say that. And the reason why that matters is because there's so many people that make their investment decisions based on what the Fed's balance sheet is. Is it going up or down? Is it QE, QT? Oh my gosh, the reverse repo is getting down to 500 billion. And, where's the liquidity going to come from for the treasuries if it's extinguished? And, the Fed continues to do QT and all these things. And you've got to step back for a moment and say, wait a minute, does this really matter? And at the end of the day, assuming that the risk is the same in the system, it doesn't matter at all.
Okay, so the one area where you said it does matter, or they're at least quite consequential, is in those times of crisis.
Absolutely.
Right? When the Fed is buying a bank and creating bank reserves, let's say.
Yeah, or they're setting up a special purpose vehicle to buy corporate debt or something like that. But that's even more so from a psychological standpoint, because like going back to 2020 when they set up that SPV to buy they only bought I don't know what it was. It was a very small amount, but just by sending that signal to the market,
backstop,
then psychologically it just takes over from there.
Right. So to try and demystify some of this, because it's easy to get lost in the jargon, in the event of crisis, economic crisis, and the Fed buys a bank by creating new bank reserves, whose purchasing power is actually buying that bank?
Well, that would be the Fed. I mean, they're basically.
Where does the Fed's purchasing power come from?
Okay, so let's back up here, because I don't know that the Fed would buy a bank, but they would bail them out in the sense that, let's just rewind, go back to Silicon Valley.
Yeah.
So if Silicon Valley would have gone to them and said, hey, let's just assume that they had the BTFP set up prior to Silicon Valley, and that wasn't a response mechanism to them failing.
Yeah.
Then what they could have done is said, hey, we've got all these treasuries, and they're at 50 cents on the dollar.
BTFP that's the program.
The Bank Term Funding Program.
Okay, thank you.
That was basically the bailout that they set up for the rest of the banking system.
Right.
When Signature, Silicon Valley Bank, First Republic, and people forget Credit Suisse went bust in March of 2023.
Yeah.
So, and the big differentiator between that and the discount window is with the BTFP, you get 100 cents on the dollar. So they have all these treasuries where, they bought them at whatever, 1%. And now all of a sudden the yield's 5%. So they take these huge haircuts, and the liability side of their balance sheet is decreasing massively. So they've got to make all these transfers. They've got to sell the assets, and they're taking a haircut. And it wipes out their capital, right? Where if they could have gone to the BTFP, they give those treasuries to the Fed, park them on their balance sheet. The Fed gives them the bank reserves at 100 cents on the dollar. And then they can go ahead and make those transactions, and it would have saved the day. Most likely, they would still be here today. So then the question becomes, okay, whose purchasing power does that impact? I don't think that really impacts any of the purchasing power within the banks itself, other than keeping the level of risk from skyrocketing. Because what happens, if we assume that there is no constraint on the bank's balance sheet, because they can settle by whatever mechanism they want, even if it's extending one another credit. If that's our starting point, right, then we can assume that the bank or another bank could have come in and created the broad money or whatever, just done a wholesale transaction to do the exact same thing with Silicon Valley Bank if they so choose. So they didn't. So the Fed came in. I don't think that increases the actual mechanical liquidity, although it decreases the perceived risk, which in turn would increase the liquidity bank to bank.
So it's a psychological operation.
Yeah, it's more of a psychological operation because, again, we have to start from the position that the banks can create as much liquidity as they want. And the only constraint is the amount of risk in the system. So now, but another interesting component there, and what Lynn has brought up several times, is if the Fed does not come in and save that bank, and let's just say they allowed the depositors to get wiped out, which they should have, beyond the FDIC, then you are actually literally decreasing M2.
Right.
Because all M2 is that commercial bank deposit liability. Yep. So if that bank's ledger blows up, then all the deposits on their ledger disappear as well. So in that so short term, it can definitely be anti-deflationary, which is her term, not mine. But what's interesting is if you look at that long term.
Why not just say inflationary there? Why did she say anti-deflationary? What is the difference between anti-deflationary and inflationary?
It's preventing deflation instead of creating inflation.
In the actual money supply or prices?
Well, both.
Okay.
Because what you're doing right there, let's just say that Silicon Valley Bank had, let's just say they had $1 million as far as deposit liability.
The money supply was supposed to go away when the bank blew up, but they prevented the blow up. So
the money supply didn't increase, but it prevented it from decreasing massively.
Okay.
Right. Now so short term, definitely anti-deflationary. But what's interesting is longer term, it may be the opposite. And the example I would use there would be Japan. So they came in and bailed out everybody. So that would be anti-deflationary. But in doing so, they created 3 decades of deflation.
Yeah. Right. Yes.
Right. So because you don't allow Schumpeter's creative destruction.
That's right.
So if we would have allowed these banks to go bust, then number one, you get rid of that moral hazard. But then also all the banks who were prudent, then they take the assets of those who weren't. And they don't have that PTSD. So let's just think about it. Let's say you and I are bankers during the GFC and we get bailed out. But moving forward, now all of a sudden we're freaked out. Like we don't want to take any risk. Like we don't want to lend out into the real economy because last time we did that, we got burned. So the only lending we're willing to do is into the financial economy to entities that we know are going to get bailed out. Right. We're like that beaten puppy dog that's like shaking in the corner, right? You don't want to do anything. And now that's not good for the real economy because we're not lending out to those entities that can produce goods and services, which at the end of the day is wealth. That's the definition of wealth. So juxtapose that to if they would have allowed us to go bust, and then our assets and liabilities would have been purchased by an entity that had a rock solid balance sheet and would have survived that storm. Well, they don't have that same level of PTSD, so they're going to be more willing to go out and lend into the real economy, where you would assume that growth and maybe inflation expectations, more so nominal, let's just say nominal GDP, would be a lot higher. And so over the long run, it might not be anti-deflationary. So there's no way, that's one of those things that's completely, it's an opinion. There's no way to determine what the outcome would be. It's just more of a thought experiment.
If you are a business owner or manager, you should know these 3 numbers: 36,000, 25, and 1. 36,000 is the number of businesses that have upgraded to NetSuite by Oracle. NetSuite is the #1 cloud financial system, which allows you to streamline accounting, financial management, human resources, and more. NetSuite turns 25 years old this year. That's 25 years of helping businesses do more with less, close their books in days rather than weeks, and to drive down cost. And finally, 1, because your business is one of a kind. So with NetSuite, you get a customized solution for all your key performance indicators in one efficient system with one source of truth. NetSuite is everything you need all in one place. Right now, you can download NetSuite's popular KPI checklist designed to give you consistently excellent performance absolutely free at netsuite.com/whatismoney. That's netsuite.com/whatismoney to get your free KPI checklist. Again, netsuite.com/whatismoney.
We want you to join us for 2 days of discussions and debate, which is all happening at the inaugural Dissident Dialogues 2024.
This incredible event will take place in Brooklyn on May the 3rd and 4th. You'll be joining leading thinkers such as Richard Dawkins, Steven Pinker, Ayaan Ali, John McWhorter, Aisha Akambi, Michael Schellenberger, Mary Harrington, Chris Williamson, Winston Marshall, Konstantin Kisin, Francis Foster, and more.
Hang on a second, since when have you ever been a serious thinker?
I love thinking, it's my favourite hobby. Sometimes, of an evening, it's all I do. Think.
Moving swiftly on, we want you to join us for a gathering where everyone is part of the conversation. Conservatives, progressives, atheists, theists, left, right, and everything in between.
Dissident Dialogues presents a rare opportunity to immerse yourself in a conversation with the most influential thinkers of our time.
We'll tackle important topics relating to religion, science, politics, and culture. If you're driven by intellectual honesty, curiosity, and a desire for the truth, Dissident Dialogues is the place for you.
It's not just an event, it's the beginning of an intellectual journey, and we want you to come along for the ride. I like rides.
Dissident Dialogues is a place for dangerous ideas. Buy your tickets now at dissidentdialogues.org and be part of the conversation.
But the financialization of the economy is something we have seen take place, which is what you're describing, right? They stop lending to the real economy, continue lending into the financial economy.
Correct.
So we see a contraction in the real economy and expansion of the financial economy.
Yeah.
Which is to basically say, well, what? We've eviscerated our industrial base in the United States since running this central bank experiment over the past 100 some odd years. I would say that's a reflection of that, right? More of the GDP has become financial rather than real economy.
Yeah. But I would say that most people peg that specifically on the expansion of the Fed's balance sheet.
Mm-hmm.
And I don't think that's precise enough. Because again, what that implies is that during 2014, if the Fed is doing $1 trillion worth of QE, that somehow is going to create extra financialization. And I don't think it does, because again, the bank's going to do what they're going to do. Where it really matters is the moral hazard that is created by the bailouts.
Got it.
So if you could, in fact, I try to go through this thought experiment on my own quite often. I try to go back to the early 1990s and assume that the Fed never would, or the central planners never would have gotten involved with long-term capital management, that they would have just
let it blow up,
whatever.
Yeah.
And then, you fast forward to the GFC, and the only thing that the Fed ever would have done is just try to maybe micromanage interest rates a little bit. And I think there's a strong argument there that they kind of ask the banks where they want the interest rate to be.
Right. Yeah.
But assuming that we didn't have any of the bailouts, where would the stock market be right now? Where would the housing market be? Would we have these massive financial bubbles, or would it be very similar to what we saw, let's say from 1930 to 1980? People forget that because just of recency bias, they think that the stock market always goes up. And we say, whoa, time out. If you look at a chart of the S&P 500 from like 1929 to 1980, that's 50 years, for heaven's sakes. And you adjust for inflation, it's pretty much flat.
Yeah.
If you look at housing, Robert, you can look at housing going back to the 1890s all the way to the late 1990s, 100 years, and adjust for inflation, and it's flat.
Yeah.
Absolutely flat. So to sit there and say, that the stock market always goes up or the housing market. Now, this is a recent phenomenon that we've seen pretty much since the 80s and 90s.
Yeah.
And I think that if you're going to peg it to one thing only, you've got to peg it to the bailouts. It isn't really. And, another example I'll give you there is, like we said, the reserves in the system, or Fed liquidity, whatever you want to call it, the same from 1980 to 2007. If you look at a stock market chart from, let's just say, 85 to 2000, and you compare that 15-year period to 2009 to, let's just say, 2024, the stock market went up more with no reserves in the system than it did by the Fed taking their balance sheet from basically 800 billion, their total balance sheet, not reserves, but 40 billion in reserves, let's say, all the way up to 3.5 trillion. So if anything there's an argument why QE actually decreased asset prices, right? Because if you see, I wouldn't come to that conclusion. That's not my base case.
Yeah.
I don't want to make it seem as, but it's an interesting thought experiment, right? Because if you've got the stock market, let's say, going up by, I don't know what the exact number was, but let's say it went up by 50% from 85 to 2000 with no additional bank reserves. And then from 2009 to 24, it goes up by like 25%. Everyone says, oh my gosh, it went up because of all the bank reserves. Well, no, it went up even more before we would have the reserves to begin with. So there's an argument that the reserves actually decreased the level of stock market increase that we otherwise would have had. But my point there is where I think the real problem is the central planners bailing out and not allowing entities to fail.
Yes. Okay. So that's what I want to ask about. So we're on the question, what is money? Here, like all of these topics come back to this question of what is money. One of the ways you have defined money in the past, in our past conversations, is purchasing power, right? It's a container for purchasing power, something like that. So if I had to maybe modify, I was asking kind of a leading question earlier, like whose purchasing power is used to bail out a bank when the Fed buys a bank. To ask a more specific leading question, since March 2020, the purchasing power of savers in US dollars has been clobbered in terms of steak, commodities, several things have gone up a lot in nominal dollar value as a result of the Fed and government intervention in early 2020 and since. Whose purchasing power, I guess, what is the mechanism by which savers had their purchasing power confiscated, damaged over the past 3 years, if it's not these direct bailouts? Because to my knowledge, there weren't any direct bailouts in that period. So how has purchasing power moved from US dollar savers? Where was it moved to, I guess, and by what mechanism over the past 3 years?
Well, it went to borrowers. It goes from savers to borrowers. But there's almost limitless variables, but I think there's three main variables. The biggest variable, I think, were the shock to the supply chains and the destruction of the supply chains by the central planners locking everyone in a cage. I mean, to think that, this is another fun thought experiment. Just go back to 2019. And if I told you, Robert, the governments over the next 2 years are going to lock everyone in their house and they're not going to let them leave, what do you think is going to happen to the economy?
Yeah, crazy.
Full on Armageddon, right? So to think that the central planners, that policy didn't impact global supply chains to a degree to which it would produce, at the very least, consumer price inflation, I think is completely naive. So I think that was first and foremost. But number two, and this doesn't really get a lot of attention, I think it is the change in velocity. And this is one thing that we were discussing. And then number two, but I think to a much lesser degree, would probably be the addition of M2 money supply. And maybe we start there because I think for most people, that doesn't make a lot of sense, because when you see the money supply go up by 25%, you're like, well, how on earth could that not lead to hyperinflation, let alone just, whatever we saw when you combine that with the other variables that we were referring to. And I think what people need to understand is, even if the Federal Reserve is buying from a non-bank entity, they're really decreasing savings, right? So if you are the person that's selling that treasury, let's say that was just your savings. You're not selling that treasury to buy Chipotle or to make your car payment or anything that's going to chase goods and services, most likely. So the fact that you're selling that treasury and then it increases your savings account doesn't really mean that you're going to take that additional money that you have in your account and actually go spend it, meaning chase goods and services, or in your words that you're using on Twitter the other day, increase demand.
Yeah.
It's just about increasing aggregate demand, right?
Okay. So you're saying people were selling these treasuries to obtain dollars as just an insurance policy against future uncertainty,
or to buy stocks, or to buy a house, or to buy assets, or something. Most likely they weren't, and they could have been. I'm not saying everybody, but in general, I think people were selling those treasuries to do things other than go to the movies, go to cafes, go on Instagram trips, all the things that the stimulus checks were being used for.
So it went into assets, or capital assets probably, or financial assets.
Or it just went into a money market fund. It went into reverse repo or something like that. So if you look at that specific transaction, Janet Yellen goes to Robert and says, I'm going to, in that transaction, we were talking about QE. So then that would increase M2, but we really don't have more money circulating in checking accounts, increasing that demand, looking at it through the Mises lens, that would actually lead to consumer price inflation because demand is outstripping the ability to increase supply, especially at a time when supply is decreasing in aggregate total, right? So that's the dynamic that's at play. And the reason, again, I don't think that M2 is a big deal is because it is, I hate to use the asset swap term because I know people don't like that, but that's really what it was. You had a cash asset in the form of a treasury, and especially if you're a pension fund, you can take that treasury and you can repo it and instantly get the actual dollars to buy the stock. You don't even have to sell the treasury. Right? You can just use it as collateral. But in the case of just a person, then you are just taking that cash asset, you're giving it to the Fed, and they're giving you another cash asset that most likely doesn't have a lot of velocity, meaning you're not going to use that to go out there and purchase stuff. Right. So that's why I don't think that the increase in M2 was a huge contributor. I think, although it did contribute some, I think the bigger contributor was, now going back to the earlier example I was using, let's just say I'm Janet Yellen, and that I'm selling you a treasury. So forget the Fed for a moment. I'm Janet Yellen. I'm selling you a treasury. So you purchase that treasury. We take your account balance down. Let's just say it's $1,000. So we take your account balance from 1,000 down to 0. But now we've replaced it with that treasury. So the asset side of your balance sheet hasn't changed. It's still $1,000. It's just the composition has changed slightly. Right. But that was currency that in your savings account that you really weren't doing anything with. You're saving the money by definition, right? So then Janet Yellen takes that money and basically spends that back out into the economy in the form of a stimulus check, where it goes into someone's checking account. And although M2 money supply hasn't increased, the velocity or the demand has increased massively, because for you, there was no demand with that money. Or at least your time preference was much, much longer. Where you're turning that into a time preference. And I don't know if I'm using the right word there, but you get what I'm saying. You're turning that into money that wants to be spent right away on the movies, on bars, on renting Ferraris or whatever it was. And then that increases the amount of demand relative to the existing supply. And that's why I was saying there's by changing the composition of M2, you increase velocity, which puts upward pressure on prices.
So you're shifting from a composition that has a higher preponderance of savingsness, if I could use that term, to being more checkingness. Right? People are
that's the way I see it in my mind. The government came in, they didn't change M2 in this scenario, this hypothetical we're talking about. But what they did is they changed the composition of M2 from savings to checking.
And to your point, that's a distribution from savers to borrowers, right? Well, not actually. This is just straight to consumers. But it's adding to government debt, isn't it?
Yes, it is. It is adding to the debt.
So when you said
assuming, but that's a great point, because let's rewind, and instead of Janet Yellen selling you a treasury, let's just say that she collects taxes. So you pay her $100,000 in taxes, and she does the exact same thing, same effect. All she's doing, even though we're not increasing the debt,
you didn't increase
we don't have a deficit
debt that time.
We're still taking savings and turning it into checking.
Right.
So almost any government spending, depending on how it's spent, you could argue that it's increasing velocity, which would make prices potentially higher than they otherwise would be.
So the only difference there is if it's done through taxation, it does not increase government debt, because taxation is government revenue, basically.
It's not increasing government debt, but it's still having the exact same impact on velocity by taking savings and turning it into checking.
So, okay. I want to define purchasing power, because again, we're definitions.
Let me go. Because I think I've actually been able to think about that. And everyone knows the definition of money that Mike Maloney gave us and Lynn reiterated,
which is
what is it? The 7 characteristics, where it's divisible, it's fungible, it's a store of value, whatnot. but
there's the 5 properties that there's people do anywhere from like 5 to 20 properties, and then there's the 3 functions, right? Store of value, medium of exchange, unit of account.
Oh, okay.
So they're 2 different answers, but they're both useful.
Yeah, the very first time that I saw that was on Mike Maloney's video, that his Hidden Secrets of Money. Shout out to my good buddy Mike Maloney. And so that's why I always kind of default back to Mike's definition. I think he had like 7 bullet points or something like that. Yeah. But the average Joe doesn't look at money that way.
Sure.
So I think that it's important to have a definition of what the average Joe sees as money, and that's why I look at it as just commercial bank deposit liabilities. And if you want to get technical about that definition, all that is an IOU on a network of bank ledgers. That's all money is at the end of the day. And you could even say that all money is a network of bank ledgers.
Yes. I would say that definition would limit you in terms of trying to define how gold was money, though.
Oh, no. I'm not saying what money should be. I'm
or
just saying,
has been, right?
Or gold, has been, or the properties that Mike talks about that are absolutely important.
You're being more descriptive of what it is today.
Of what most people, if we just went down Brickell just grabbed 100 people,
paper in my pocket or numbers on my,
and we just asked them with a microphone, what is money to you? And 99% of the people are just going to say whatever's in their checking account.
Yeah.
So, okay, we can be a little more sophisticated and say, okay, well, what that is just an IOU from the bank or a commercial bank deposit liability.
Yeah.
And then what is that, just from a philosophical standpoint? All that is literally just a network of bank ledgers. That's it.
And underneath that are the goods we have produced and not yet consumed, right? This is another terminological thing that's important. We often say savings as if it's a purely monetary thing, like savings, how many digits are in my bank account or my Bitcoin balance. But the pure economics definition of savings is goods that have been produced but not yet consumed. So that network of interbank liabilities lays claim to the real wealth, as the term used earlier, the actual goods and services available in the world.
Yeah.
Right. And so if those goods went away, well, that money all of a sudden would be worthless.
The example I always use is if you're stranded on a desert island and all you had was a chest full of $1 billion
and gold,
you're poor. You're poor because there's no stuff.
Right. I want to go back to purchasing power just to try and define it, because we throw this term around. I think a lot of people probably don't know it. People are familiar with price. Typically, we're actually looking at goods and services in terms of dollars, for instance. Purchasing power is really just the price of money in a way. You're actually, instead of looking at goods in terms of dollars, you're looking at dollars in terms of goods, right? So beef is $30 a pound, right? That would be the price. But you could also say $10 is worth a third of a pound of beef, right? You can just basically flip that. You can do the reciprocal of the price to get the purchasing power. And that measure matters more than the nominal price of things in a way, because again, it's a matter of what you're aiming at. So, and we talked about this earlier, why it's problematic to try and have a universal metric for inflation. You can't just say inflation's 8%, because 8% of what? Like, what am I buying? What do I intend to buy? Each market actor has like their own coefficient of the things they want to buy.
Because I buy different things than what you buy.
Exactly. Yet the government tells us, oh, it's 8%, it's 3%, it's 5%, right? It's just not true, basically.
Yeah.
It's almost like trying to quantify valuation itself. I can't say that, I value water 5%. In economics, they say it's an ordinal, not a cardinal.
Yeah.
So you can't, you have a first best friend, second best friend, third best friend. You don't have first best friend that's 65 points, second best friend that's 47 points. It's 2 different ways of quantifying something. And purchasing power is so important because, this is one of the definitions of money, right? It's like the thing that holds
store value,
the most purchasing power, right? And so the thing that, how does this, my question here would be, how does purchasing power relate to monetary premium? Because, we hold certain goods with the intent of either consuming them or trading them in the future for other goods. And it has been said that to the extent you hold something with the intent of trading it in the future, that thing has a monetary premium, right?
Yeah.
Could be Beanie Babies, could be
Yep.
whatever the thing is you're trading. Maybe it's water in the desert, like everything. And back to your point on moneyness, everything has some degree of this monetary premium associated with it, right? The more widely demanded it is, and the less likely I am to consume it, more likely I am to trade it, the more moneyness it has. The thing with the most moneyness is what we call money typically, or the thing with the most purchasing power.
And I would argue stability.
Stability in terms of purchasing power.
Yeah. So I think if you asked most people, would you take this currency unit that had a 100% chance of maintaining its purchasing power over the next, let's just say 1 month?
Mm-hmm.
Or would you take this currency unit that could go up by 20%, but could also go down by 20% over the next month? Even if, taking this back to Bitcoin or gold or something, even if the probability was much higher that over the next 5 years, it would have a lot more purchasing power. For a lot of people, they're going to take that $1 that they can depend on. Even if there's annualized, let's say a 2% loss or something like that,
Right.
because their expenses are denominated in that currency and they can't afford to take that risk, even if the long-term probability is that the value of that more volatile currency relative to goods and services goes up.
But wouldn't you say it's not a binary yes, no. It's a matter of portfolio composition, right?
Yeah. And
some percentage checking dollars,
absolutely.
some percentage Bitcoin savings.
Yeah. So savings, it would make sense as to why, or we can just look at it from a standpoint of a business, right? If you've got, or a sailor, use him, so he's got his savings and he's leveraging to buy Bitcoin. Well, he's putting that over in this bucket, right?
Yeah.
But I would highly doubt that he's taking the working capital for his business and storing that in Bitcoin.
No. Yeah, right.
He's storing that in dollars because he knows that he's going to have to pay payroll next 2 weeks.
That's right.
And that he doesn't want to take the risk of Bitcoin going down by 5 or going up by 5 or whatever it is, right?
Yeah.
He just wants those dollars. So he's compartmentalizing that.
Yes.
And I think that's spot on. But for most people, they're not in sailor's position where they're saving quite literally billions of dollars.
Right.
The vast majority of their paycheck is purchasing power that they need to use in the next month.
Yes, and this is a very important point. Short-term purchasing power stable versus long-term purchasing power stable.
Yeah,
right?
it's where are you placing value? It depends on how you're utilizing that asset or that additional. If you want to look at, I love your way of looking at it because it's excess productivity.
Yeah,
it's what have you produced above and beyond what you've consumed.
Yes, which is another good way to think about money is that it's kind of like productivity points.
Yeah,
it's like when you go into the market and you produce, but you don't yet consume, you get a paycheck.
That's savings,
right? And as long as you don't spend that money, well, you produce something, but you didn't consume anything yet. But you have the potentiality to consume in your savings, and your pay ideally in a free market would reflect that, right? Like how much savings you've accrued is how much you have produced more than what you've consumed. Basically, that would be a proxy for what your savings actually is. But you need, I guess in fiat world, we have this issue of the dollar's long-term purchasing power unstable, obviously, right? It goes down over time, almost as
more so with Americans.
Yes.
To a degree, foreigners, but more so with Americans.
More so with Americans. And I would say this is obviously post the Fed. So since 1913, I would say the dollar purchasing power goes down in the long run to the same extent gold's purchasing power has gone up more or less.
Yeah.
There's been some price manipulation around that. But you also need, for checking purposes, you need that something that's short-term purchasing power stable. And so this is, you're right, sailor's in a different category, but the principle is sort of the same, right? You want to earn more than you spend in the
it's
short
just putting
run.
in different buckets.
That's right. And then put something aside.
And as we speak right now, and who knows, hopefully it'll change in the future, but as of right now, there are different monies, let's say, or currencies that are better for certain buckets.
Yes. Another definition of money I want to ask you about, I mean, maybe you agree or don't agree with it. Money's been called a final extinguisher of debt. So an instrument that you use to settle a debt.
Yeah,
basically.
yeah. That's interesting.
How does that fit into the central bank fiat currency world? Because there doesn't seem to be a way to settle this debt with finality. I mean, it depends how you have to get into the definition of debt, but I look at inflation as almost being a form of counterparty risk, right? You have a counterparty.
Yeah.
You have a liability that's built into the dollar, basically. It's like, even if I put the dollar under my mattress, the Fed can still print it and debase my purchasing power. So my purchasing power is not safe cash under the mattress. There's not really any way for me to discharge that liability fully until I sell those dollars for gold or Bitcoin.
I would phrase that a little bit differently. I wouldn't put that onus on the Fed. I'd put it on the government. Because again, if we're assuming that the banks can settle without using bank reserves, without using cash, and I would just point to the Eurodollar system since 1950, they've been doing that very, very well. It's basically a system without base money. It's just all broad money, right? But assuming that they can do that, the Fed really doesn't impact the amount of currency units that are chasing goods and services, other than if they increase, anti-deflationary, or if they just happen to be buying from a non-bank entity that's selling, but they're not really impacting checking, they're more so impacting savings. So I think that the central planners are definitely to blame for that. But I think it isn't so much the Fed, it's more so the federal government and their spending distorting the economy, which has created the consumer price inflation that you have seen since 1913. And another just kind of argument that I'd make there is, if you look at the Fed's balance sheet from like 1950, because obviously they had an impact during World War II. But from 1950, let's say, to 2007, their balance sheet didn't even move. Now, as far as bank reserves, I think just right at the top of my head, in 1950 or in the late 40s, there was about 25 billion worth of bank reserves. And you fast forward to 2007, it was 40. So how can you possibly blame inflation on the Federal Reserve between those time frames? You can't. There's no way that you can. Now, I'm not saying that the Fed is pure as driven snow. I'm the guy that wants to end the Fed, but for other reasons. I'm not here to sit here to say that the Fed was responsible for the inflation of, let's just say, the 1970s or any of the inflation that we got from 1950. You can't peg that on the Fed because the balance sheet didn't change. They didn't do anything.
So, two-part question then. What reasons do you want to end the Fed? And what is the relationship between the Fed and the government's ability to spend?
Okay, so let's go back to 1940 because it's a better example of when they came out and implemented yield curve control. If you just look at their balance sheet, it's not obvious that they went out there and purchased bonds. But I had this conversation with Lynn, and she correctly pointed out, because she did the research for her book, that she read the Fed minutes during the 1940s, and they actually did buy treasuries and there was a few times when, let's just say, the long-term interest rate got above their target, which I think was 2.5%, where they actually had to come in and buy treasuries and kind of implement that yield curve control. Now, to what degree they did, I don't know. And then the other question becomes, let's say they would not have done that. Would interest rates have been materially higher? That's a counterfactual that we'll never, ever know, right? But but let's just set that aside for a moment and just assume that they actually did play a big role in the government being able to spend more money than they otherwise would have, because the argument there is if the Fed would not have kept interest rates low, interest rates would have gone up, and that would have made it more onerous on the government, right? So that's a great argument for the 40s, but unfortunately, once you get past the 1940s, it doesn't go anywhere because they weren't buying bonds. They weren't buying treasuries. Now, you'll see the Fed's balance, if someone really wants to get specific and look me up on this, you'll see the Fed's balance sheet increase, but that's not a result of bank reserves. That's just simply a result of currency in circulation. So you see, George, what's the difference? The Fed was printing currency. Does it matter? Well, it absolutely matters, because the only reason they printed currency, and I think I tweeted the other day and no one understood what the hell I was saying, which is, again, a problem with Twitter. It would have been better if I would have been able to say it. But I was talking about how the only way that we really have currency is it's just when a bank replaces a commercial bank deposit. So if you have $1,000 in your checking account and you say, hey, bank, I don't want this. I want the actual green piece of paper now. They're going to give you those green pieces of paper. But if they didn't have them to begin with, we'll just look at the whole banking system as a whole. What they do is they go to the Fed and they say, hey, we need $1 billion worth of cash this year. Now, this is just cash that we're giving our customers to replace what is already existing M2.
Right.
They already have the money in their
digital
account.
To physical.
Yeah, that's all they're doing. It's not like we're adding any purchasing power. We're just changing the composition of the purchasing power that already exists, which, by the way, was just a result of the bank lending to begin with.
Right.
It goes back to the bank creating money. Yeah. They're not lending money. And so then what the Fed does, say, fine, we'll give you that $1 billion, but we're not going to increase the size of our balance sheet or anything. We're just going to decrease the amount of bank reserves, the amount of electronic bank reserves that you have by $1 billion, and we're going to give you that $1 billion of the cash.
Withdrawal, basically.
Right. Yeah. And then you're going to take the $1 billion of cash and give it to your customers. And then that's the offsetting asset and liability is your bank reserves decrease, and then your deposit liabilities decrease by the same amount. Yeah. That's why I came out with a tweet the other day and said, listen, if you really want to get technical about QE and QT, you're going to have to look at currency in circulation because that's doing the exact same thing. You're just reducing the amount of bank reserves and you're reducing the amount of deposit liabilities. So my point there is you will see the Fed's balance sheet increase from, let's say, 1950 to 2007, but that's a result of M2 going up as a result of banks lending and therefore people just wanting currency. They're not adding to the currency supply. They're just changing the composition. That's why I get hyper-focused on the amount of bank reserves. And when you look at the bank reserves from 1950 to 2007, there's no change at all. So you can't argue that somehow the government got a good deal because the Fed was buying those treasuries, which otherwise would have had a higher interest rate because, again, they weren't doing anything.
Okay, so why do you want to end the Fed? Because it sounds like if I didn't know you, I would sit here and think you were a Fed proponent.
Yeah. So it's a great question. So what is the Fed? The Fed is the Wizard of Oz. Or another way I like to look at it is the Fed is the Indian witch doctor, Native American witch doctor, whatever, that goes out and does the rain dance. Okay, and everyone thinks that guy controls the weather. So if we all believe that he controls the weather, he mechanically does not control the weather. Now we can prove that through science. Yeah. But if we believe that he does, and if he wants us to go out and buy more seeds because he owns the local hardware store, he's going to come out and not only is he going to dance, but he's going to dance for like 3 hours straight. So you and I are like, holy cow, did you see that, Robert? He not only came out and danced, but he danced for 3 hours this time.
Better buy a lot of seeds.
Oh my, exactly. We better go buy a lot of seeds because it's going to pour rain and we need to take advantage of these bumper crops that we're actually going to have. So this is a distortion on what the free market, it's a psychological distortion. It's not a mechanical distortion. That's the key difference there. But it's still a distortion where if we could just go to that Native American tribe and say, wait a minute, guys, you don't understand. That dude in the feather hat, he's not making it rain. He wants you to think he's making it rain, but in reality, he's not. So what you need to do is I'm going to give you this iPhone with a weather app on it. And next time you want to determine how many seeds you should buy, just look at the weather report on this app and forget the stupid guy in the feather hat. And in doing so, we would allocate resources much more efficiently.
I love the double analogy here of the Fed making it rain.
Yeah.
So basically what they're doing, right?
Exactly.
Or not, I don't know, printing money, not printing money.
But that's
the capacity to expand M2.
Hopefully that makes sense.
Yes.
That's why we really have to end the Fed and also their ability to distort the market by bailout.
Yeah.
Those are the biggies.
What's coming up for me there is we've talked a lot today about the mechanics of money, but there's also this psychological dimension to money, right? That the Fed is leveraging or messing with, basically, as you're describing with this guy doing the rain dance. They can induce different market actor behavior based on the market actor's belief that they are the Wizard of Oz and control this thing when maybe in fact they don't. What's going on there? I don't actually have a definition for this.
You see what's exciting about that to me, though, Robert, is that we can end collectively.
Yeah.
We could end the Fed tomorrow.
By disbelieving in it. Yeah.
There you go.
Yeah.
We can end the Fed by forgetting the Fed exists.
Yeah. Well, that's a beautiful, beautiful idea. This also ties into something we talked about offline earlier. You said, I think this was an argument that Lynn made. There was a changing psychological narrative related to Bitcoin. There's a particular chart she showed you. On the top.
She tweeted it out, and I commented on it. I actually saved it on my phone.
This is on the topic of the psychological aspect of money, that there appeared to be more what we were calling diamond hands holding Bitcoin with each price cycle, right?
Yeah.
So Bitcoin's price goes up, holders sell, Bitcoin's price of it, the selling eventually gets exhausted and price crashes. And then more either, I don't know if it's the same, obviously we don't know who the composition is, but the amount of long-term holders tends to increase
with
over
every
time.
cycle. Yep.
And you were making the point that this reduces the float, so it actually increased volatility, most likely to the upside if that pattern held true, that it was going into tighter and tighter hands, let's say, over time. But what are your views on this psychological aspect of money, and how does it pertain to Bitcoin's ongoing monetization?
Well, this is where I'm probably
Is it just a narrative? Is it just like you said, we could end the Fed by disbelieving in it? Can we make Bitcoin global money just by believing in it?
No, because you need the goods and services.
Forget multivitamins and other supplements. Animal organs are the most nutrient-dense foods on the planet. You can get 100 times more nutrients from organs than you can from muscle meats. But the problem with eating organs is that they are difficult to find in stores, they are difficult to prepare, and even when they are prepared well, they often don't taste great. Thankfully, Heart and Soil Supplements has made consuming organ meats so much easier by providing powderized organs in capsule form. Organ meats include everything your body needs to thrive: vitamins, minerals, peptides, proteins, and growth factors. This is why organ meats were the most prized foods for our ancestors. Fortunately for us, Heart and Soil makes these treasured foods easily accessible. So go to heartandsoil.co today and use discount code BREEDLOVE to get started on your journey to optimal health and vitality. Again, that's heartandsoil.co, discount code BREEDLOVE. Over the past 9 years, I've been going through a pretty serious struggle with my personal health. It started with a sharp pain and stiffness in my hip after a lifting injury, which I later learned was related to some pretty extensive inflammation in my gut. Then I developed an autoimmune issue, and soon I was having joint pain all over, skin irritations, and all kinds of digestive issues. I visited many doctors trying to figure out what was wrong, but none of them were able to help me fix any of my issues. I eventually started to see an energy healer with whom I had some limited success, but it wasn't until I started working with the biohacker Anthony DiClemente last year that I was finally able to start making real progress on my healing journey. Anthony spent a lot of time with me learning about my specific situation and worked with me to adapt a custom health plan to address my needs. Anthony has served as a personal biohacker for celebrities, billionaires, and professional athletes all over the world. Besides helping people like me overcome health issues, Anthony and his world-class medical team also help guys that just want to optimize their cognitive performance, guys that want to pack on some muscle, and guys that just want to get shredded. Anthony keeps a tight book of business and is selective about the clients he brings on. To apply for Anthony's biohacking services, text BREEDLOVE to 847-943-7221. Again, to apply for Anthony's biohacking services, just text BREEDLOVE to 847-943-7221.
So right now, the main reason I'm a huge fan of Bitcoin is because it gives us an out.
Mm-hmm.
And I believe that central bank digital currencies are just a matter of when.
Yeah.
They're not a matter of if. And I think it's really important that we recognize how powerful our opposition is.
Mm-hmm.
I think one of the big mistakes that we make in Bitcoiners and gold bugs and everything that they make is that discounting the popularity of a central bank digital currency.
Yeah.
I think it'll be wildly popular.
Well, because of yield, right?
Or
UBI yield.
Potentially yield, but also I think features.
Yeah.
That you'll be every single time I see someone that's, they go to El Salvador or something or they can pay for stuff so easily with their Bitcoin app. And that's really cool.
Yep.
Right. You're going to have that with a CBDC. Trust me.
Sure.
And the difference is it's all going to be free.
Yeah.
So you're going to be able to go to Mexico and pay with Mexican pesos or whatever it is, free of charge. There's not going to be a spread on the currency conversion. You're going to be able to settle 24/7. Businesses are going to love it. Now, once they come out with these draconian Orwellian type of 1984
Social
stuff,
credit score.
Sure, people are going to recoil a bit. But my argument is there's no way the central planners are going to come out with that stuff first.
Yeah,
there's no, they'd be stupid to.
Yeah.
So they're going to come out with all the features and get you hooked on it.
Yeah.
And then they're going to start rolling out all of the
Controls.
1984 stuff.
Yeah.
And I think that we as proponents of freedom and liberty and the freedom of choice and free market capitalism, we have to understand that we've got an incredible opponent. I mean, this is going to be the challenge of a lifetime because almost every single normie, I think, is going to gravitate to that CBDC. First and foremost, they're not going to call it a CBDC.
Of course not.
They're
Freedom
just
coin.
They're not even going to call it that because it's nothing different than just dollars. It's just dollars that are just a liability of a Fed instead of the liability of your commercial bank. And so they're going to say, look, we've had all these banks go bust, Robert. So what are we doing here? Why don't we just take the deposit liabilities from the banks that can go bust and put it on the balance sheet of the one bank that cannot go bust? And in addition to that, we can get rid of the FDIC. So all you libertarians out there, you should be for this, right? Because we can get rid of this entity that's quasi-government in the FDIC. That's a good thing. And also for all you libertarians out there, you want everyone to be treated equal. Well, fine. If we move the deposit liabilities onto the Fed's balance sheet, then the Fed can pay the same interest rate on checking to the average Joe that they can pay to Jamie Dimon.
Yeah.
This is because interest on reserves. Yeah. So this is their argument. So you think about that, and the average Joe, he's not looking at this through the lens of 1984 like you and I look at it. He's just looking at all these features that are coming at this and saying, "This is incredible.
Yeah,
this is, and I have no risk. This, and we don't have to worry about a banking crisis ever again. Why would I not do this? This is a total no-brainer." So you have to, that's the Goliath, to use Weinstein's term, that's the Goliath that we're up against.
Yeah.
And I think it's a real mistake for people within our community to discount Goliath and say, that'll never work. The general public will never buy into that because it'll just be hyperinflation. Now, you don't understand how they're going to, look, if you and I were rolling this out, would we just come out and make this big press release that we're doing all these social credit scores and we're moving to Fed coin? Of course not. We do it under the radar. And so we get people addicted to the network, just like your cell phone. I use that as a thought experiment. I say, how many of the people out there with a smartphone, pretty much 100% of the people listening to this podcast right now, how many of you would give up that cell phone tomorrow if you knew that your actions or your activity on the cell phone would lead to a social credit score?
That's a good question.
I mean, what?
Right.
99% of, no matter how much
Most
of a libertarian you are,
know what a social credit score. I mean, they might know what it is.
I'm even talking about to a libertarian audience, or to your audience, or to my audience. I guarantee you, 99% of the people, they might say that, I would give up my cell phone, no problem. I don't even like it. Right. Talk to me in a month.
Yeah.
And you're going to rationalize, well, okay, Breedlove, you've been talking about CB. It's not that bad. I'm going to, as they're checking their Facebook and stuff like that.
No, that's a great point. And long thought that they would bait people in with yield or UBI. And then
same thing.
That's all you need to do right there, right? Give people free money.
Yeah.
They'll download that app in a fucking heartbeat. They don't care about the central bank legal monopoly or anything, And libertarians, maybe they would agree. I don't know. As a real libertarian, you'd have to say no. But does the Fed still require a legal monopoly? Well, then that's a problem.
But would they even know, Robert?
If you're a real libertarian, I think you would know.
No. Here's where I'm going with that. So you and I, you were gracious enough just to provide an incredible lunch today that we had. But
not me and my lady, but yes,
your gal. I don't want to disclose her name or anything. But she went to the store, presumably, to buy the ingredients for the lunch that she made. Okay, so let's just assume that she banks with Wells Fargo, so she's got a Wells Fargo ATM card. At the end
she only spends my money though,
or your money. Right. We won't get into the red pill stuff right now. We'll save that for Rollo Tomasi and Rich Cooper. But how would we know that those dollars were actually a liability of Wells Fargo?
How would we know that the dollars are actually a liability of Wells Fargo? I don't know.
We don't. Yeah. We don't. Just because it says Wells Fargo on the card, and so what?
Yeah.
Those could be a liability of the Fed. We never know it. We'd never ever know it.
Well, isn't every too big to fail bank that has dollars effectively a liability of the Fed because the Fed will bail them out?
Yeah, but I'm saying the fundamental components of a CBDC is where your dollar assets are a liability of the Federal Reserve. So as Lacey Hunt says, they're taking base money and they're turning it into legal currency, or taking bank reserves and turning it into legal currency. Or as Lynn would probably say, you're taking base money and turning it into broad money.
Yes.
Right? So we have no way of knowing if we're actually spending base money or broad money. We have no way of knowing that. We could be doing that as we speak. Yeah. And we don't know whose liability those dollars are. And if they were a liability of the Fed, then that's all centralized onto one ledger. And that is the fundamental components of a central bank digital currency, no matter what you want to call it.
So we could already be on a CBDC or something?
We wouldn't even know. I'm not saying we are.
Yeah.
But I'm saying we wouldn't even know. So for all of those people that are proponents of DeSantis, or the other day Trump came out and said that I'm never going to allow a CBDC. Okay, Trump doesn't even know it won't. Trump wouldn't know a CBDC if it hit him on the side of the head.
Yeah.
And the central planners, the ones that are really in charge, they're not going to announce it.
Sure.
They're just going to subtly move it over there. And if they do announce it, it's going to be with all of these selling points. Not that it's a CBDC, but we're just moving the liabilities over here. You'll never know it.
Yeah.
Nothing will change except for you never have to worry about taking a haircut on your deposits. And we're going to give you the exact same interest rate that we give Jamie Dimon.
Yeah.
And we're going to give you UBI. And we're going to make it just as easy to use as Bitcoin or anything out there that you're using right now. And when you go to other countries, you're going to be able to transfer, and you're not going to have to pay a fee.
Yeah.
And it's just going to be the most incredible thing since sliced bread. And the average Joe is going to buy into that. They're going to absolutely buy into it.
I agree with you. And I also think this is why education about money and the monetary system is so important, because it preys upon this generalized ignorance that people just don't know any better, right? They're told that, it's as good as Bitcoin or as good as this, and they'll just believe it, right? They don't understand that, the Fed is inherently fraudulent, basically, right? It has this moral hazard built into it that it can bail out these failed institutions.
Yeah.
And
and not just that, but that they control your money.
Yes.
If they don't like something you said, like the other day.
That's a good question, actually.
I don't know.
Is it really money if you can't fully control it?
Well, it's not your money.
Yeah, it's someone else's.
I guess. Yeah, I don't know if we would consider. Again, it goes back to that definition of what is real money and then what is perceived to be money by the general
Our bank reserve is controlled by the Fed.
Oh, yeah.
So that's not money in that sense, at least, because it's not under your full control, even if you're the bank.
Yeah, they control their balance sheet. Now, you could argue that the banks kind of tell them what to do.
Sure.
That kind of be my base case, but they do control the level of bank reserves. But then the question is, do the bank reserves matter?
Right.
And if the bank reserves don't matter outside of times of crisis, then we can't make any financial decisions based on the Fed's balance sheet or the amount of bank reserves going up by $1 billion or down by $1 billion. Now, I think where Bitcoin is most exciting for me is because it gives us a way to transact outside of the system where they cannot control. They don't have their finger on the button.
That's right.
So if you want to tell them to pound sand and go down to Argentina or something like that, you can vote with your feet and you can easily take your purchasing power with you. Whereas I'm a huge fan of gold and silver as well. But the reality of the situation is if you have $50 million in gold, you're not putting that on the plane and flying to Dubai tonight.
No.
That's going to be...
You're definitely not doing it without government permission.
That's going to be a logistical challenge, to say the least.
Yeah.
So, I mean, Bitcoin is just absolutely fantastic from that standpoint. What we have to really focus on right now, and I wish that there was more of an emphasis on this as opposed to like the ETFs and BlackRock and whatnot. And I know that there's a lot of super, super smart people working on this because Lynn tells me about it all the time. But we need to make sure that that ecosystem is growing with the Bitcoin to where things are priced in Bitcoin and we can transact exclusively Bitcoin for goods and services without having to go Bitcoin dollars, goods and services.
Yeah.
That's the secret sauce because right now, if
that's
we were
psychological too, though, George, because that technology exists right now, like Lightning.
It's just willing to use it.
It's a matter of, do people know about it? Do they have it downloaded? Will you accept?
But
Bitcoin?
that goes back to vol.
Yeah.
See, this is the catch-22. This is the paradox because I think that mechanically, the more people that hodl, the lower the float, the higher the vol, which disincentivizes people to actually use that to transact in a alternative ecosystem, which would give us the ability to maintain our standard of living outside of the current monetary system. And the reason I say that, I make that distinction, maintain our standard of living, because if you and I wanted to set up a little Amish community right now and only use Bitcoin, we could do that. There's nothing stopping us from me, raising dairy cows or something, and you growing wheat and corn, and we just transact back and forth with Bitcoin, and everything's priced in Bitcoin. The problem is that's going to reduce our standard of living quite substantially because we're not going to be able to get the UFC pay-per-view tonight.
That's right.
There's a lot of sacrifices we're going to have to make in order for that to happen. So that's what I'm talking about is and I think that we've got to realistically look at a hybrid type of scenario or plan. So I don't think that the Bitcoin ecosystem is going to grow fast enough to outpace the oncoming central bank digital currency, unfortunately.
Gotcha.
So I think that we have to be just realists and understand, okay, in the next 3 to 5 years, we'll likely have this CBDC thing. So it's not realistic for me to completely transact outside of that system if I want to maintain my standard of living. So what I'm going to have to do is I'm going to have an account with the Fed, let's say. And so when you're getting your sponsorship money for this YouTube podcast, or when you're getting your AdSense from YouTube or something like that, they can dump it into that account. And then whatever dollar expenses you have to pay, you just bam, bam, you pay them immediately, just like the people do with their paycheck in Turkey.
Yeah.
Right? They get the Turkish lira, they spend it as fast as they can, then anything that they have left over, they instantly turn it into dollars, Bitcoin, gold, silver, euros, something like that. Yeah. And so I think we're going to have to do the same thing where the money comes into our account, we spend it on the stuff we have to monthly as quickly as we can, and then anything that is left over, we try to get that out of the system and get it into Bitcoin, gold, silver, whatever, or even cash for that matter, as if they're assuming they still allow it, as quickly as we can. And then we transact outside of the system using the forms of money that we have that aren't going to impact our social score. So you've got this massive, I don't know if that's a diesel. That is a diesel.
Oh, yeah.
Yeah, so you're going to be on their hit list for sure. Your social score is going to like instantly be zero with the amount of diesel you got to purchase. But you could just, you could buy that diesel from someone else that is willing to take Bitcoin or willing to take gold or cash or something like that, to where the government doesn't know about it. And there's just no way that they can micromanage that. The risk reward, they just don't have the resources to actually do it. Yeah. So I think that's, for me, what is most exciting about Bitcoin. But the super interesting thought experiment is to think about how that plays out, assuming that we have increased vol, while at the same time we need decreased vol for further adoption in the utilization for goods and services based on that 1 month time frame that we talked about earlier when we were referencing the compartmentalization of cash flow, working capital, and savings.
Yeah, so I want to dig into that because it's an interesting point. One observation: Bitcoin's volatility has contracted as its market capitalization has grown in the long run. Now, that doesn't mean point to point. Obviously, it gets very volatile in bull markets, very volatile bottom of bear markets, a lot of low volatility in between. But if the dynamic you're describing is cycle to cycle, Bitcoin diamond hand holders increase, which constricts the float, which increases volatility, which puts upward or downward pressure on price, depending. But when Bitcoin gets into the bull markets, the float expands again, right? Because holders start selling.
Correct.
Presumably less if there's more diamond hands coming online. So isn't there a counter-cyclical mechanism built in there too, somewhat, where it wouldn't be purely increasing volatility as Bitcoin
it's just decreasing vol to the upside, though, on that, and from that standpoint, because the whales, if you will, are providing that liquidity. They're the ones that are selling into that spike, into that rally. And I wish we had the chart, but every single time when you get that big spike, the hodlers, or whatever you want to call them, they're selling into that. So the percentage of people that have owned their Bitcoin for over a year, I think that's the way the chart works. And you guys can just check Lynn's feed, and she tweeted this out a couple weeks ago. And what you see is that go down. So let's just assume we start at 20%. It goes up to 30%. Then when you get a big spike, they sell into it. So the amount of hodlers, total percentage, goes, let's say, from 30 down to 25. But it never goes back down. It always has a higher low than before.
Yes.
Same
with the price.
Yeah, exactly. Yeah. So that's why if this trend continues, I think that you're going to see more vol because of the decreased float, but higher highs and higher lows, because every single time you do have that liquidity component that you're talking about, but it never goes back down. It always goes back to a level that's higher as far as that hodl rate than it was at the beginning of the cycle.
And this is what we call number go up technology. It's amazing stuff.
It is. But the thing, I try to play devil's advocate with myself, and I think, okay, because it is right now literally engineered for the number to go up. Exactly what you're saying. I think there's mostly a psychological component to that, and obviously a mechanical from the standpoint of you can't create more in the mining and whatnot. But I think and I have no way of knowing this, but if a lot of the Bitcoin was purchased on leverage, that could be a fly in the ointment.
Oh, yeah. And we've seen those liquidations.
Yeah, because then you could have, especially with a super low float, it could go no bid, especially if you're like in a recession, to where I don't see, I'm not sitting here saying the price is going back down to $1,000 or something like that.
Yeah, but March 12th, 2020 was a great example.
But you could just get like a air pocket, so
Bitcoin was already low March 12th, 2020, like maybe 8K or something. And then it got cut in half overnight when they announced COVID. And it's that situation, right? People are levered long thinking you're at the bottom of a Bitcoin cycle. Yeah. Then all of a sudden, it's a global lockdown.
Yeah. So now, again, let's put things into different buckets here. Because the most exciting thing for me about Bitcoin is the ability to transact outside of the system. The price is not that interesting.
And save outside the system? When you say transact, you mean save and transact?
Yeah, I would put savings in there as well. Although, again, that's your definition, because are we saving for
power.
a year, or are we saving for 20 years? If we're saving for 20 years, then yeah, I'd put it in there.
Yeah, okay.
But if we're saving for 2 or 3 months, there's still a little bit too much vol for me to put it in that bucket. But my point is, if now forget the outside of the system stuff, right? Which I think is the most important thing. Now let's just focus on strictly the price, right? And so that's where I think psychology plays a huge role. And what I think could be like one of the best opportunities ever is if we go into a recession and you do have some leverage there and you hit one of these air pockets, and boy, that could be just such a massive buying opportunity, because then, you get that price down, but you know that the diamond hands, if you will, are still going to be there, and you've only got the weak hands selling, but because the float's so low, you get that downside vol and that tail risk that if we have a serious recession, which the yield curve is actually predicting, and then you're able to get in there, and then the next ride up is most likely going to be just violent.
I was going to say, you also have the wall of central bank liquidity coming behind that, or maybe not central bank liquidity.
Yeah, I would more so say government liquidity.
Government liquidity. So there are, well.
And then psychologically, let's think about this. And there is no doubt that people today are in a mindset of gambling, and it's gotten progressively.
I think this is inflation induced.
Oh, I agree. Yeah. I agree. Yeah, I think there's a lot of components. Yeah, but I definitely think that's one of them. Yeah, I think that could be a really neat opportunity if you're someone that's just looking at Bitcoin as far as a trade or something like that. Yes, definitely something I've got on my watch list.
Very cool. I want to ask you, because you mentioned this, you posted this. You said you don't write that often, but recently you spent some time writing to try and clarify your own thinking.
Yeah, just try to sharpen my thinking on a specific topic.
And this is, you posted this as a Twitter thread or an X thread titled "The Dollar Crash Paradox."
Yeah,
I haven't had a chance to read this yet, so I don't have any good questions.
I can just give you the Reader's Digest. Yeah, first of all, if any of your viewers look at that, keep in mind that is a rough draft. I mean, there's spelling, there's grammatical errors. I've actually refined it probably 4 or 5 times, and now it's in a final draft that my digital marketing guy is going to turn into like a lead magnet for our email list.
Oh, cool.
But we're only going to do that for about a week. After we do that, I'm going to open it up to the public, and they can have free. They don't have to give their email to have access to it. But really, it's going over the mechanics as to why I think it would be very unlikely to have a dollar crash. Now, that doesn't mean that the dollar can't go down. And again, defining terms here, when I say the dollar crash, I'm talking about relative to other goods or other currencies.
Oh, yeah, of course.
Not to goods and services in the United States. In fact, I think that there's 3 options that I think an entity could utilize if they choose to de-dollarize. And one of those options I think would be massively inflationary here in the United States. But ironically, I think it would increase the value of the dollar relative to other currencies at the same time. So you have this weird, well, actually it's not that weird, because if you look at 2019 to today, we have had the dollar crash by many people's position against goods and services here in the United States, but yet it's higher on the DXY, much stronger. So it's not that bizarre of a situation. But if you understand the mechanics behind the global monetary system, it makes a lot of sense. And our starting point is that dollars are lent into existence. Most people, even a lot of the experts out there, they think that the bank lends dollars. So the more dollars the bank has, the more dollars they can lend. That's not the way it works.
Right.
The bank doesn't need any dollars to lend, because I create the money for you, and the offsetting asset on my balance sheet would just be the loan that I just created. Right. So there's no constraint there other than settlement. And that takes us to a whole other rabbit hole. But that's the starting point. You got to understand. So now what makes that different from Argentina is that we've got a different pie chart. Right. So let's just say that this pie chart represented 100% of the existing currency units that were outstanding, Argentinian pesos and then dollars. So dollars, especially outside of the United States, like 99.9% of them would be lent into existence. Where Argentinian pesos, let's say like 50%, would be quite literally printed, like pieces of paper that were printed, and they were not lent into existence. Yeah. So why does that matter? Because just like what we were talking about at lunch, if I lend you a green piece of paper, I didn't increase the money supply. Right. And if you pay me back that green piece of paper that I lent you, that doesn't decrease the money supply. But if I am a bank and I lend you money by increasing the money supply, increasing the currency units in your checking account balance, then you pay me back the next day, we've increased the money supply, we've decreased the money supply. So what is really weird is the demand has a huge impact on the actual supply.
Right.
So, the example people always use is like Saudi Arabia dumping dollars because there's no more petrodollar, something like that. Okay, fine. Let's assume that they dump $10 trillion. Well, let's remember that those $10 trillion were lent into existence. So someone has to have those dollars in order to pay the bank back.
Right.
So then the question becomes maturity. And this is huge. And this is something that I try to really emphasize in that Twitter thread. If I lend you money, and let's just say it's a balloon payment, no interest, is balloon payment, and it's a 30-year maturity, well, you can do anything with the money. I mean, you're not worried about paying it back. You got 30 years before you have to make that payment and get those dollars back. So basically, there's intrinsic demand with however much I lent you because it has to be paid back. But that intrinsic demand isn't going to come due for 30 years.
Right.
So effectively, it's not really there. But you compare that to if the maturity was 2 weeks. Now, all of a sudden, we got a different problem. Because you may take that money, let's say it's $1 million, and you may need it very, very quickly to make payroll. But within 2 weeks, you're going to need to get that $1 million back, therefore demand, to pay me, the bank. And when you do pay me, the bank, then the money supply is going to decrease by the amount that I lent you to begin with, which was the $1 million. You see? So if we understand, if that's our starting point, then we go through the three actions that the Saudis could take, right? Number one is that they could just, if they don't want dollars anymore, they could just sell their dollars for Russian rubles, let's say. Okay, well, someone's going to buy that. So in the short term, that could absolutely decrease the value of the dollar relative to other currencies. But eventually what's going to happen is there's going to be an entity that needs those dollars, like I said, to pay back. So what are they going to have to, if there's not enough circulation, going back to velocity, of the dollars in the system, they don't have enough cash flow, they're going to have to, and how can they get a bank loan? Well, we're de-dollarizing, so the banks don't want to lend dollars anymore. So they're not even able to roll over that. I'm taking it to an extreme to understand the concept, but they're not even able to roll over their debt, right? So the other entities are only going to have one option. It's take their own currency and dump that to get the dollars that were dumped to begin with to pay off the loan. You see? So that's option. So what in that scenario, what happens is the dollar absolutely can go down, but likely it's only going to go down so far. And if you think about it in terms of, let's just say there's $50 trillion outside that were lent into existence. So the aggregate balance sheet, if you combine everything outside the United States, you got 50 trillion in assets, dollar cash assets, and then 50 trillion in dollar denominated debt, which would be the liability, right? So you've got the dollars being dumped, the 10 trillion, but then they recirculate, paid off, which takes the amount of dollars in dollar denominated debt from 50 down to 40. So you're still at kind of an equilibrium. And then the only factor is how long was it able to circulate before it had to be paid off. And that's why maturity is so important. And every single expert that I talked to, and every single, I looked at the BIS and a bunch of different reports, it's all short term outside the United, not all, but the vast majority is short term. And I would say the vast majority, especially when you include interbank, is under like 6 months.
Wow.
And in talking to Snyder about it, he was saying that the vast majority of the interbank stuff is probably like 2 or 3 weeks. Very, very short term. So now what would option number 2 be? Option number 2 would be, okay, they don't want the Russian ruble or the Chinese yuan or the BRICS currency or whatever. So they just want to say, I just want U.S. assets. I want to buy half of Manhattan.
Right.
So this is an inflation hedge, it's cash flow, it's all these things. So then those $10 trillion come into the United States. Well, now all of a sudden, relative to the outstanding dollar debt, we have an undersupply outside of the U.S. because we have 50 trillion of liabilities, but we only have 40 trillion in cash because 10 trillion came back into the United States.
Yeah.
But now we have an oversupply in the United States. So let's say that our balance sheet inside domestically was 20 trillion and 20 trillion. Now we've got 30 trillion and 20 trillion. So you've got many more currency units circulating, chasing those goods and services, which most likely would put upward pressure on consumer prices. But while we have an undersupply of dollars outside, so you got the dollar ripping higher against other currencies, while at the inside, people are experiencing 10, 15% per annum consumer price inflation, and it's just crushing the poor and middle class. But then let's take that to the next step. What does Jerome Powell do? Increases rates. So what does that do to all those entities that are short dollars outside of the United States that have that dollar denominated debt?
Borrowing costs.
It increases their borrowing costs. It basically makes that debt burden a lot more extreme than it was to begin with. So what do they have to do? They have to sell more of their Mexican pesos on their balance sheet to get the additional dollars that they need to compensate for the increased interest rate.
Right.
And therefore that makes the dollar go even higher, and it takes you into this kind of doom loop. But that's not all, because you got to think about the 50 trillion of dollar liabilities, that debt that is owed. That's an asset of the bank, the banking system in total, right? That is interest rate sensitive. So if Jerome Powell increases interest rates to a certain degree, that decreases the value of the assets on their balance sheet. So it's a global monetary Silicon Valley Bank scenario.
The last part where increasing rates decreases the asset value, is that due to bad debts?
So yeah, there's going to be a lot of defaults, but more specifically, it was because of the inverse relationship between the interest rate and the value of the debt.
Oh, just the value of the bond itself.
So if they have a loan on their balance sheet that's 5%, it's just basically like having a treasury.
Yeah.
So therefore, if the interest rates go from 5 to 10, the value of that loan on their balance sheet decreases substantially. So if they have to get rid of that, if they need that liquidity, they're going to have to take a massive haircut. And then people, the next step is always like, well, if no one pays back the debt, then those dollars are still circulating, chasing goods and services. No, you don't understand, because that's when it goes back to what is money.
Yeah.
And that's why I said specifically that money, in this case, is just an IOU on a network of bank ledgers. Why is that important? Because if the bank goes bust because you don't pay them back, then the money disappears.
Yeah.
Because the ledger disappears. And if there's no ledger, there's no money to begin with.
Ooh, that is interesting. So I guess you would not agree with the earlier point, that the earlier definition of money, that it's a final extinguisher of debt, because what you're saying here.
Well, I would. That's exactly what it is.
Oh, so what? I mean, this money we have now is debt, it sounds like. So isn't that an oxymoron?
But it extinguishes the debt.
Okay,
so I don't know if we might be talking past one another, but
it's mind melting to me. It's born into existence by borrowing.
Yeah.
But it also extinguishes debt.
Right.
So where's the asset of the money that's extinguishing the debt if it's born into existence as a liability?
It's the widget that's made, hopefully.
Okay.
And that's why I'm such a big fan.
So back to the interbank liability network being underpinned by goods and services, basically.
It should be.
Yeah. Well, if it's not, there's no point in the money, right?
I mean, it should be. It should be. But now, even with the Eurodollar system, it's been so over financialized. But I have to ask myself if it would have gotten. I mean, right now it's completely out of control. But would have it gotten that out of control if we never would have bailed out long-term capital management?
Yeah.
And see, the problem there too, Robert, is yes, that now the Fed wasn't directly involved other than negotiating that deal and whatnot. But you can say they're obviously directly involved with GFC, COVID and whatnot. Yeah. But then let's just say that we eliminated the Fed from the equation. Would the government not have stepped in and done the exact same thing?
But how? How would they have financed it if it weren't for the Fed?
Oh, they just would have borrowed the money.
From who? Private market, at least.
Oh, yeah.
Well, at least it wouldn't.
Remember, the banks can create the money out of thin air.
The banks can create the money out of thin air, but if they lend to borrowers that cannot repay, then those banks go bust.
No, because they're lending to the government.
Yeah.
So
okay, well, but you're saying if the Fed's not there, then the government is a counterparty that could also not repay.
Okay, so
then those banks could go bust.
No, yeah, right. If the Fed is not there to backstop the banks, but let's just assume for a moment that the banks aren't at the level of risk to where they're going bust, right? The banks could easily finance that debt that they're getting from Janet Yellen in this case. And the way that I like to think about that is understanding that prior to 2007, the majority of Janet Yellen, I'm just using her as a fill-in for the Treasury.
Yeah.
The majority of the Treasury money was actually commercial bank deposit liabilities. See, now we think of the Treasury's money just being on the Fed's balance sheet in the form of the TGA.
Right.
So what's a really cool thought experiment would be
TGA?
The Treasury General Account.
Okay.
Yeah, that's a liability of the Fed on their balance sheet. But what's funny is asking, okay, since it's a liability of the Fed, if there were no bank reserves, could we pay taxes?
Can you say that one more time?
so the Fed's balance sheet, let's just say this legal pad.
This just reminded me of this quote. This was actually at the Occupy Wall Street, right? They were picketing signs that if they can just print money, then why do we pay taxes?
Yeah.
And so this sounds like it's getting close to that idea.
Well, yeah. So let's just say this is the Fed's balance sheet right here. And this middle section is the TGA, right? They're getting paid through bank reserves. Because what happens is, let's say you pay $100,000 in taxes, your Wells Fargo account goes from $100,000 down to zero, and then your bank, Wells Fargo or the Fed, takes those $100,000 in bank reserves and takes them from their account, and it goes down into the TGA. The only way the TGA gets paid right now is through bank reserves.
Yeah,
that's it.
Right.
So base money, not broad money. So if you took just as a thought experiment, it's kind of fun. If you decrease the level of bank reserves to zero, could the TGA get paid? Because it cannot accept broad money. It can only accept base money.
Isn't that just an administrative change?
It is. It is. So it's a trick question because this takes us back to prior to 2007. They had the TGA, but they didn't really use it. What they use are accounts called, if my memory serves me, it's TT&L accounts. And these were basically commercial bank accounts that were accounts of the Treasury. So if you think about the fact that a bank can create as many commercial bank deposit liabilities as possible, and the offsetting asset is the loan, well, there's nothing really to prevent them from creating more commercial bank deposit liabilities for Janet Yellen and just offsetting those with the Treasury.
Right.
You see, now they would have interest rate risk and whatnot, but I mean, I guess you could theoretically say that they could buy enough to do yield curve control themselves.
Yeah.
But even taking it out of the hypothetical, I don't know that the Fed would have had to buy anything because we have to look at what really creates price movement at the long end of the curve. And it's really about growth and inflation expectations. So if we are to assume that if the government is coming out and issuing all of these treasuries, but yet the global economy is wanting to contract at the exact same time, it gets to a point where interest rates will only go that high to where the risk reward makes a lot of sense even for the average Joe and Jane, especially outside the United States, where they're not worried about the inflationary pressures that government spending creates to begin with. You see, so that Japanese investor that doesn't care if we have a 10% CPI, all they care about is the dollar relative to the yen and their local goods and services. And if the dollar is going up against the yen, hey, give me more treasuries, give me more. And if you give me more at 5.5, if it goes up to 6, now I'm really buying. I'm backing up the Brinks truck because I'm just getting that much better of a deal than it was at, let's say, 3%. And then the last thing here I'd like to remind people is when you're looking at demand for treasuries, what most people do is they look at that through the lens of a retail investor in the United States. Like, why would I ever buy a treasury when I know that I'm just going to lose purchasing power over the long run? Okay, but again, you got to look at this from the major buyers, and that's entities outside of the United States, including the banks and the Eurodollar system that are using that treasury for collateral.
Right.
Remember the moneyness that that Monoman, Manmohan, I always mispronounce his name, Manmohan Singh talks about, right? And if you've got that treasury and you're looking at that risk reward, even if you got a little bit of risk that you're going to lose purchasing power in the States, you don't care because it's so liquid. And it's such a perceived to be a safe liquid asset. It is absolutely liquid that you can use that to make so much more money. Just as an example, rehypothecation, that the slight amount of risk, and even if you take a 3 or 4% haircut based on goods and services in the States, who cares? Who cares? I'm buying that treasury all day long at 6%. So my point is, although it's completely perverse and I don't like it, it's almost like there's an ingrained bid for treasuries because once the yield gets up to a certain level, there's going to be that buyer because of all this additional demand that is created outside of the domestic economy through the banking system and collateral and through foreign investors that are to where it makes more sense as a store of value for them than the American investor.
So this sounds a lot like you're describing a system in which the dollar is almost unable to crash as rapidly as other currencies because the treasury is the bottom of Exeter's pyramid, or it is the global risk off asset, and it's also supporting the Eurodollar system.
Thanks to my friends at Swan Bitcoin for supporting the show. Swan sponsored the Sailor series, and I appreciate their support from the very beginning of the What is Money show, and I'm happy to welcome them back. Swan has grown a lot since then. They've built a full-service, Bitcoin-centric financial services company with several different offerings. With the Swan app, you can set up instant and recurring Bitcoin buys. And with this, you can get started at swan.com/breedlove. Swan also enables clients in the US to hold Bitcoin directly in an IRA account, so you can hold Bitcoin in a tax-advantaged way. Get started at swan.com/IRA. If you're looking to buy more than $100,000 worth of Bitcoin, check out Swan Private. You'll get concierge support for buy execution, retirement accounts, inheritance and estate planning, and access to exclusive events, research, and other content. Get started at swan.com/private. Swan Institutional provides financial services to institutions, including Bitcoin-backed lending, asset management, principal investments, Bitcoin services for financial advisors, and Bitcoin mining operations. For those new to Bitcoin, I recommend checking out Swan's Welcome to Bitcoin course at swan.com/welcome. So go to swan.com/breedlove today to get started on your Bitcoin buying journey. Are you sick of being robbed by politicians through inflation and endless money printing? If so, you need to be at Bitcoin 2024 in Nashville, Tennessee on July 25th through 27th. As the largest Bitcoin and Fintech conference in the world, Bitcoin 2024 stands as a beacon of monetary freedom, a glimmer of hope amongst a darkening macroeconomic backdrop. Top speakers, companies, and thought leaders from across the industry will convene in Nashville to look ahead to the next year and beyond. I will be there, and Bitcoin conferences like this have become my favorite place to socialize since becoming a Bitcoiner. Ticket prices will increase soon. Get your tickets now and secure your spot at this game-changing event. So go to b.tc/conference and use discount code BREEDLOVE to sign up for the Bitcoin 2024 conference. Again, that's b.tc/conference, discount code BREEDLOVE.
Yeah, so I would put that into two different buckets. Yeah. I would say that I think there's a very low probability that the dollar crashes as a result of the way that the monetary system is structured from the standpoint of the majority of the dollars being lent into existence outside of the United States.
Right.
So therefore, demand controls supply to a certain degree. Now, once we've discussed that, we move over and say, okay, well, how does that impact treasuries?
Yeah.
Because if Jerome Powell is increasing rates because we have inflation here locally in our domestic economy, well, that's going to really increase those rates. And maybe at the front end it does, but I think you get a massive inversion there because I think you're still going to have that bid at the long end. And even at the front end, too, if they're raising rates, I think you're still going to have that bid because of the collateral and the moneyness component of those treasuries outside of the domestic network. And
how much does this parallel the dollar milkshake theory? Because it sounds like, I mean, that is sort of what Brent's theory, right?
Yeah.
Isn't he's describing something similar, right? That basically, no matter which way you cut it on a relative basis, everything feeds back into the dollar. The dollar is going to decline less rapidly than other currencies because the dollar and treasuries are backing all of this international euro dollar system.
Yeah, I mean, I would go so far as to say it might not even decline. Now, again, I want to be super clear. I know we've beaten a dead horse.
Yeah,
but
it can decline in purchasing power terms in the U.S., but not in terms of other currencies, basically.
Because a lot of people use that analogy is that, hey, all these currencies are just a parachuter.
Yeah.
You know, there's a skydiver coming down, and it's just the dollar is coming down to earth at a slower pace, but it's still coming back down to earth. Yeah. And I would argue that potentially, no, we could get into an environment where the parachute guy is actually going up closer to the plane.
In terms of actual real goods and services.
Yeah.
Wow.
Not in the States, but in Japan. I mean, I'll give you an example of Colombia. That's where I spend most of my time. And the Colombia, the inflation rate since COVID has been right around, what the government admits to, right around 10% or something like that. But the dollar has appreciated even more. Now, it's come down recently, but at one point, like when Petro was elected, the dollar got up to almost like 5,000 to 1.
Wow.
So when you look at the appreciation of the dollar, it appreciated way more than the value or the price of local goods and services went up. So for me, it was like a windfall because I'm collecting money on my T-bills, just drop the dry powder, let's just say 5%, but the currency is appreciating by 10% per year, just throwing that out as an example, relative to the cost of my goods and services. So that's an example of the parachute actually going up.
Right.
It's not just going down. And if we see a big, so I think like Brent, the risk on the dollar, as far as the tail risk, is to the upside. It's not to the downside. Although I completely see how, sure, the dollar theoretically could go down to 80, 85, 75, something like that. Absolutely. Especially get interest rate differentials and whatnot. But the real tail risk there is on the upside. Now, I think Brent looks at it from a slightly different angle. He looks at it, the central banks and the government spending relative to the ECB, relative to the BOJ, relative to the Bank of Australia, something like that, and saying that, look, the United States, whatever you want to argue about the United States as far as deficit spending and all these things, they're going to do it to a much greater degree. So it's a relative game. Gotcha. Where I completely acknowledge that, but I come at it from a little bit different angle and just looking at the mechanics of the monetary system itself, and then showing that even if that the Saudis, just using them as an example, de-dollarize to a great extent, and then outlining those three options that they would have. Number one, sell for other currency, buy U.S. assets, or just pay off their own debt. You see how just mechanically, it's very, very difficult for the dollar to go down in value relative to other currencies. And if it's not, then the question becomes, okay, well, what is the probability of it losing reserve status in the next 5 or 10 years if it has this mechanical edge, if you will? And people can come to their own conclusions. I'm not saying they have to agree with me, but at least acknowledge the mechanics that are at play here.
So it sounds like if it were possible that the US dollar were to ever hyperinflate, every other currency in the world would hyperinflate first before the US dollar.
That's Brent's point.
What do you think? What are your views on the possibility of a US dollar hyperinflation? Is it even possible?
Oh yeah, absolutely. But the mechanics, the system would have to change. So, like as an example, if we went to a CBDC, that's a game changer. That's a game changer.
Okay.
Now
in terms of
now
because people cannot leave the system.
Well, not so much, because then the Fed has control of broad money. See, right now, the Fed only has control of base money. And I would argue that has almost no impact other than Lynn's point, anti-deflationary. But other than that, it has almost no impact on broad money.
Oh, this goes back to you, because you mentioned Lacey Hunt earlier, right? That he said if the Fed ever changed its charter to where
from bank reserves turning into legal tender.
Right. So
that's
same principle,
a different way of saying the exact same thing.
Yeah.
That they're just taking base money
that would
and
be
turning it
stage
into
one of
broad money.
hyperinflation.
Yeah. And I think because he throws in Gresham's law there.
Yeah.
And
so then does a CBDC, if it's the same thing by a different principle, does that mean CBDC accelerates USD hyperinflation?
It could. That's how you get there, right? So I think the question when you're trying to think through hyperinflation is in this thread that I have, how could that change mechanically? Because it absolutely could. That's just recognizing the system as it is now. If we go to that environment where base money is now broad money, or the Fed control, the central planners control the broad money, and the banks don't, or they don't to the degree to which they do today, then now they're literally printing money. And that takes us into an Argentina.
Gotcha.
Because the difference between, I would argue, that the main difference between Argentina and like Japan or the United States is that Argentina, the increase in money supply that you see there was a result of literal pieces of paper that even if there's nothing to reduce the supply.
Right.
Where if like in the 1970s, the big increase in money supply that we had in the United States was a result of bank lending. Okay, but again, different mechanism there where the demand controls the supply, so supply can actually go back down. Where Argentina, the supply can't go back down because they're just these pieces of paper. So if you take that concept and apply it to a central bank digital currency, it's the exact same thing. Because if they're literally printing currency units, the central bank is controlling, they're printing broad money. They're not printing base money. They're printing broad money. And that's the stuff that's circulating, chasing goods and services. So by a CBDC, you're doing the exact same thing. Same thing. Now, how would they utilize it? Who knows? But they would have the ability then to create hyperinflation, where today that's very low probability.
I'm hearing the commercial banking sector, let's say in the United States today, is functioning as something like a risk manager, that it's actually only lending money to qualified borrowers, whereas in this world of CBDC or Fed printing broad money, they would just be more indiscriminately printed and distributed.
Yeah, because they have an infinite balance sheet.
Right. Okay.
At the end of the day, what is money? It's simply an IOU on a bank ledger. Well, if there's only one ledger, that bank cannot go bust. It's not possible, because then what they are is a scorekeeper.
Unless we stop believing in it.
And then they can't really go bust.
You said we could end the Fed earlier if we disbelieve.
Oh, right. I'm talking, but they'd still have a physical location and whatnot. They could still keep doing what they're doing.
Their purchasing power could go, if it's a balance sheet unbacked by a commodity, right? So you could actually just stop believing in it and their purchasing power would go away.
Yes. I mean, at the end of the day, people could just stop accepting dollars. I mean, I guess there's an MMT argument there that you have to use it to pay taxes and whatnot. And therefore that creates intrinsic demand for it. I mean, that's a completely separate rabbit hole.
The muzzle of a gun can create demand. No argument with that.
Yeah. But what I'm saying there is so remember when we were at lunch and we were talking about the Bank of Robert and the Bank of George, and if I create money or deposit liabilities, I'm lending them into existence. That increases that portion of my balance sheet. The offsetting asset is the loan that I just created. So I didn't need money to begin with at all. The only time that money or credit or anything like that interbank comes into play is if I have to transfer that liability over to you. Then I need an asset to give to you, even if that asset is simply an IOU. If there's only one bank, that bank never has to transfer an asset. Never. It's just transferring from one liability account to another liability account.
IOUs all the way down.
That's right.
Yeah.
So you and I would both be on the one bank, and if I had to transfer you $100,000, they would simply deduct my account by 100 and add 100 to yours. But there's no asset transaction.
Yeah.
So then you ask the question, does the bank even need assets? The answer is no, because if there was just one bank, all they would be is a scorekeeper, just like at an NBA game. That's all they're doing. And so they cannot go bust. And a great example of this was Gazbank in Russia. During communist Russia, I think they started in, I believe it was 1922, right around there. And, they survived all the way until, the communism came crashing down in the 1990s. But this is one bank, and their central bank was the commercial bank. It was all just one.
Right.
And you go back and
Argentinian style.
I don't know if that's Argentinian.
Oh, I thought you said earlier it was. I may have been mistaken.
No, their central bank was actually creating, money that was not lent into existence. I would call that printing money.
Oh, okay.
But with Russia, it was just one bank.
Okay.
Right. There was one bank.
Yeah.
It was the central bank, and it was every branch, commercial branch. It was all one and the same. So my point is one ledger. That's it. And if you read about how they were able to utilize, the central planners utilize Gazbank, it reads exactly like a central bank digital currency. They were able to micromanage every single transaction. They were able to lend to entities that had political favor. Why? Because they didn't have to worry about being paid back because they can't go bust because they have an infinite balance sheet.
Right.
See? So going back to your original point, yes, right now, it'd be even better in a free market with no bailouts. But the banks are incentivized to lend to entities that can produce enough stuff to pay them back plus interest.
Sure, right.
So therefore, this is a good system.
Yeah.
It's not perfect, but it's pretty darn good. But now what you have is a system where there is no incentive whatsoever to lend productively.
Right.
You're lending based on narrative. Well, if we have this disadvantaged group over here, Robert, it's not fair. I mean, you're a straight white male, so your interest rate should be 10% if we even give you a loan, although you could easily pay it back. Where this person over here, they're from an XYZ disadvantaged group, so we're going to give them a loan for $10 million, even though they have a 500 credit score. And does it matter? No, because we're being equitable. Well, you're not going to get paid back. So what? We have an infinite balance sheet. Now, all of a sudden, they're creating that base money, and they're creating it at a level that's never going to self-extinguish, and it just gets more and more and more, and they're doing it in a way that is for consumption, or I would argue, leads to less productivity, much less productivity. So therefore, you have more currency units chasing a lesser amount of goods and services.
Hyperinflation. So, and this is a consequence of moving from a more decentralized system to a more centralized system, right? The commercial banking sector almost provides some level of decentralization.
Correct.
In the current paradigm, CBDC takes that away.
Yeah, because you got different ledgers.
Right.
You've got different ledgers. Every single bank right now has their own ledgers. Now, are they connected on a network? Absolutely they are. But what we're talking about is consolidating that entire network onto one ledger.
Right.
And therefore, if you don't have to transfer an asset, that's the key. Right. That's the secret sauce.
That's right.
Whenever you get into a position where you don't have to settle at all, you don't need assets, then you can lend for whatever reason you want because you don't have to get paid back.
So that's a pretty strong argument that CBDC could be an accelerant to US dollar hyperinflation.
Absolutely.
What the hell can people do right now in their lives to try and prepare for that possibility?
I think you have to have purchasing power outside of the system. I mean, this has been a recurring theme in our conversation, but you can't overstate it. You got to have some Bitcoin. I don't care if you're Peter Schiff and you hate it. You got to have some, man. I mean, you got to have some. Even if you think the price is going to $1 or whatever you think, it's too valuable of a commodity in its transferability across borders.
Yeah.
Like right now, in a couple hours, I'm getting on a plane to Dubai. There is no asset that I could take a massive amount of purchasing power and put it in my back pocket, and they're not even going to check it at the airport. that is unbelievably valuable. And then you and I can buy that diesel, and I can sell you that diesel back and forth, and we don't have to worry about the social score. And we can do that in a way where we just transfer back the exact change, and I don't have to worry about dividing my gold coin and all. There's just an incredible amount of advantages to having something like that. So why not have it just as, forget the price, just as part of your plan B, for heaven's sakes.
Do you include physical gold in that purchasing power outside the system?
Absolutely.
Yeah.
Absolutely. Bitcoin, physical gold, silver. I know people hate it, but the reality is cash.
Yeah.
Cash is, you got to have that as part of your plan B.
Yeah.
And then lastly, and this is probably what people pay the least amount of attention to, passports. Passports. Before you and I started recording, we were saying that most of the people in the Bitcoin, not most, a lot of the people in the Bitcoin space say, well, this is a panacea. I don't need to worry about anything because as long as I have my Bitcoin, if I don't like what they're doing here in the United States, well, I can just shoot down to El Salvador and all the capital is going to go into El Salvador. Their economy is going to boom and I'm going to live happily ever after. Right. But that's assuming that you can get outside of the United States. If you physically cannot leave, then all that Bitcoin in your back pocket isn't doing you any good at all in terms of increasing your freedom, liberty, or getting outside of this network of a social score. So you, especially in today's day and age, I think you've got to be cognizant of all of those things when you're setting up a plan B.
I think it's well said. I summarize all of this by saying in times of great uncertainty, the optimal strategy is optionality. Right?
Yeah, there you go.
Passports, residence cards. Also throw in guns, food, bug out places, just plans, contingency plans, right? Because who knows, right? When you talk about the specter of US dollar hyperinflation, like that's easy to rattle off that sentence, but the consequences of that, like if you study the history of hyperinflation, things get ugly, man. It's like a mass psychosis. Talk about the psychological aspects of money, but when money hyperinflates, people actually go crazy.
But let's not forget about the other tail risk. Right.
Oh, let's sweeten the pie. What is it?
Well, the other tail risk is the dollar going up.
Yeah. Okay.
And I would argue that possibly could be even worse than your hyperinflation scenario.
Would this be the dollar actually milkshaking all the international currencies?
Yeah. Ooh. I mean, I think they'd come out with Plaza Accord 2.0. But if I had to choose which would be better for the global economy and for just humanity, the dollar going from, let's just say it's 104 today. The dollar going from 104 down to 50, and I know that wouldn't qualify as hyperinflation, but that would be severe inflation, let's say, or a severe devaluation relative to other currencies. Would I choose that, or would I choose the dollar going to 150? 50 all day long. Instantly, I would choose 50. 50 actually wouldn't be that bad. I mean, it'd create... our imports would go up and whatnot. But as far as globally, that would really lift that burden of debt that are on all these multinational corporations that likely could be contributing to the economic recession that we are experiencing right now. So people like to focus on the United States. Robert, let's look at the UK in recession. Japan, recession. Germany, recession. Many countries in the Eurozone in recession right now as we speak, even with low unemployment in their countries and their stock markets at all-time high. They're still in recession. So the fact of the matter is we are in a global recession right now. It's just a matter of to what degree.
This is another aspect of the paradox then, right? We're insulated from recession as well because of the centrality of the US dollar.
I wouldn't say recession. I would say maybe deflation.
Okay.
But you can have an inflationary recession.
But the U.S. is not in recession right now, right?
Well, technically not. I mean, I think there's some argument that we may be. But technically, no. We still have real GDP growth. But again, it goes back to what we were talking about at lunch, is if you're measuring inflation accurately, then would we really have real GDP, or would we be negative when you adjust for the real rate of consumer goods going up? And I think there's a solid debate there for sure.
The Wizard of Oz and or central planners are really good at cooking those books, and so we never really know
I
what
think
numbers we're working with.
Yeah, I think they're probably cooking the unemployment numbers as well. But when you look at the fact that we're in that global recession, therefore the money's not circulating as fast, therefore lower cash flows for those entities that have the dollar denominated debt. That increases the burden of paying back that debt. That means more defaults. That means more banks blow up. More banks blow up increases the risk in the overall system, which obviously the banks in the United States are a big part of that. So I would argue that it's even if we're not in recession right now, very low probability that the United States doesn't go into recession if we have China, Japan, and China's not technically in one yet, but they probably will be this year. You got China, UK, Germany, Eurozone, all these places go into recession. The United States doesn't. In fact, I went back and did a study for one of my videos recently where I looked at how many times going back to the I think it's like 60s or 70s, where the United States avoided recession with the UK and Germany being in recession. Zero times. Wow. Zero. So my point there is that if we have a situation where that velocity of money slows down due to an economic slowdown globally, that's going to increase the burden of the debt. So if we could get the dollar going down on the DXY, that would decrease. That would be an offsetting pressure to the debt being more and more and more of an impact on their balance sheet, which would definitely improve things. Where if you have it going up to 150, holy cow! Now you got that's where the house of cards comes crashing down, and that's why Brent says that in that scenario, there's a 99% probability that they'd come in with like a Plaza Accord 2.0.
Fascinating stuff. George, I appreciate you coming out, man.
Yeah.
I kept you long enough. You got a plane to catch. This has been awesome. What a mind-blowing exploration, right? And just trying to get your head around some, you would think somewhat simple terms, right? We use these things every day, but it leads you down all these rabbit holes.
Yeah, that's right.
It's just so fascinating.
Yeah.
Where can people find you on the internet?
They can just go to my YouTube channel, George Gammon. I have another YouTube channel called Rebel Capitalist. And if you want to check out the live event that I'm doing in May 31st in Orlando, Rebel Capitalist Live at rebelcapitalistlive.com.
Awesome. Thank you, George.
Thanks for having me.